Fed is going to, I think, deliver a very, very hawkish message.
How patient will they be to get down to their policy objectives?
They do feel they're restrictive. They would rather just hang out at these levels for longer.
It's entirely possible that the Fed chair could lead us to a path where there's a little bit more tightening of financial conditions.
We need to hear what he has to say, how he characterizes the environment before the market can resume what I think will ultimately be another push higher.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
It is Fed Decision Day, live from New York City this morning. Good morning for our audience worldwide, leaving behind a very messy month of April and kicking off May with equity futures negative by 0.5% on the S&P 500. Overwhelmingly, south side note after south side note, basically saying the same thing. We're looking for a hawkish Chair Powell. Well, this next hour is about the following. Hawkish relative to what? Relative to the last time they met? Relative to what the market is priced for, because one bar, Bramo, is a whole lot higher than the other.
Which is a reason why some people are saying that probably sell the rumor and buy the news, that basically people are going to come in, and given how much people have built up shorts, expecting bonds to continue the sell-off, are going to be sorely disappointed, because Chair Powell basically, hawkish means him coming out and saying, we're not sure, we haven't made as much progress, we're still monitoring it. We're not going to say anything about something that rhymes with Wyke, but we're going to move forward.
Wyke?
Yeah, I don't know. Tyke?
Hike.
Mike,
just say hike.
Okay, hike. Right. Well, I don't think he wants to say the H word.
2-year, 10-year looks like this, Bramo. Yields through 5% yesterday on a 2-year off the back of ECI. 5.03% on a 2-year this morning. This from Alan Ruskin at Deutsche Bank. I think this is the stat of the day. The 2-year note has rallied on all of the last 4 FOMC days, 8 of the last 10 final FOMC days of meetings since February 2023. Chairman Powell has one gear and struggles to get out of it.
That gear being dovish. That gear being, well, we kind of still want to cut. And this is really the key question. Is he going to go full pivot of the pivot? I can't even say it. You're going to go U-turn, but I'm going to say, is that what he's going to do? Or is he just going to say on the margins, we're not making as much progress? And is that enough for a market that is looking for something more?
Well, we heard from Stephen Stanley yesterday of Santander putting out a note, and he basically starts his entire thesis was, I was viewed as I was in the crazy camp because I was calling for maybe one cut this year. What he talked about the fact is not so much Powell is dovish, but that he really wants to bring the consensus of the committee when he answers those questions. But I love this. He says, in any case, in light of the violent market reactions to some of his pronouncements last year, Powell seems to have resorted to a very bland, bare bones set of responses to the questions. So I think that's what everyone's kind of expecting, a very bland Powell, unless, of course, to Lisa's point, he decides to go there and say the H word.
What was crazy 3 months ago is consensus now. So the big question we need to hear in the news conference is this from Julian Emanuel of Evercore. He joined the programme yesterday. Pop in a question to Chair Powell at the news conference. Could you see the Fed's next move as being a rate hike under any circumstances? You talked about this. How does he navigate that? And we mentioned this in yesterday's programme. This is the obvious question. He should be prepared for it. There should be an answer written down on a sheet of paper in front of him. How's he going to address this?
Why doesn't he say something very simply like, we think that monetary policy is in a good place, that if we keep rates at this level for a prolonged period of time, we will get inflation under control. We are open to all possibilities that may arise should the information warrant it, but the bar is incredibly high given the fact that we've already done a lot of hiking.
Did you draft the answer for him?
I'm just thinking that's what he should be saying.
It'll be some version of that.
That's what he's going to say.
That was very Fed-like. That was beautiful.
Thank you. I appreciate it.
Look out for more of that. If you like that kind of thing, 2:30, there'll be a news conference. It'll be that on repeat for about 60 minutes. Tune in to Bloomberg TV and radio. Equity futures right now on the S&P 500, negative by 0.5% on the S&P. Yields in the bond market kicking off May with yields higher by a single basis point and getting closer and closer again to 470, 469. We had a stream of guests in the last 24 hours saying basically don't tune in. This is going to be a snooze. Pouring freezing cold ice water over this one.
And yet, if he says anything that surprises the market one way or another, if he is as boring as everyone says he's going to be, then that's going to be news in and of itself, because watch out for this rip-roaring rally into bonds, particularly duration. And so I think even if it's boring, it's going to be really important to watch. And I personally am fascinated.
Special coverage starts at 1:30 Eastern time. That was the promo.
Thank you.
TK's dropping by. Look out for that show a little bit later this afternoon. Coming up this hour, Max Kettner of HSBC as stocks cap the worst month of the year. Bloomberg's Mandeep Singh as Amazon shares rise on AI demand. And David Rosenberg of Rosenberg research counting us down to the Fed. We begin with our top story. US stocks coming off their worst month of the year as investors prepare for a more hawkish Fed. Max Kettner of HSBC saying this: while higher for longer rates and only gradual rate cuts might sound scary at first, we remain at our maximum overweight on high yield credit and overweight on both equities and EM debt. Max joins us now for more. Max Kettner, Max overweight. Talk to me about why.
Yeah, good morning. I think I'm probably more in the camp of what Lisa was just saying. I think we're all pretty desperate on getting something exciting out of the Fed. But let's be honest, when we look at, for example, what the Fed did 5 months ago, this dovish pivot pretty much out of nowhere, right, out of the blue, it would be very, very strange if they boxed themselves in now to basically saying, OK, the next move might actually be a hike. So I do think, we're going to get probably something that sounds more hawkish relative to the last meeting, but relative to market pricing. Look, if they give us 1 or 2 cuts instead of 3 in the dot plot, it won't really move the needle an awful lot. If anything, I think it probably does take away the tail risk of that, like you call it, of that H word, right? So it probably takes away that kind of tail risk. And then, in fact, I think that's probably looking then again pretty Goldilocksy. That then should be leading to a bit of a relief on the duration on the yield side, and that should be really then feeding through across the asset classes, where particularly risk assets in absolute terms can benefit even more from that. And then we'll suddenly actually find out, look, yields have just basically moved higher because growth is really good. It's nominal growth that's really good. It's margins that are still rock solid. It's earnings growth. Look at the earnings season. Look at earnings beats, surprise factors, much higher than pre-pandemic averages. So at the end of the day, yields have just moved higher because growth is good.
Can we unpack a word, though, a very loaded word, and that's Goldilocksy? Max, the start of the year, you were talking about reverse Goldilocks. I want to understand what's changed and what that word means now.
Yeah, I think the starting point has changed. The starting point is tremendously different compared to the start of the year. When we look at the start of the year, for example, a 1-year inflation swap was at 180, 190. We've pushed almost up to 3%. Yeah, when we look at, for example, rates volatility, that has, despite the increase in yields from sort of 380 to 430 in the 10-year, that's actually declined throughout most of Q1. That's now shot higher as well with that sell-off in duration. When we look at nominal forwards at the start of the year, we actually had sort of 1 month forwards, 3, 4, 5 years out. We had them trading at 3 or even below 3%. That has changed significantly now, such that they're trading now between 4.20 already. So even if inflation does end up being over the medium term, not at 2, but more at 3 or even above 3, we're now pricing the Fed at very, very high positive real rates far out the future. That clearly has changed. So the starting point has really changed significantly.
So Goldilocksy, let's go with it. I like it. Is it Goldilocksy for everyone or just for big tech, essentially? And if you look elsewhere, especially at small caps, they're going to get really slammed by some of these higher rates. And if you talk about margins, not doing so hot at the likes of Starbucks or even McDonald's, given some of the pressure on $6 lattes. So at what point is this Goldilocksy only for the AI trade and everything else kind of has to follow along and watch with envy?
Yeah, I guess you're probably more in an advantage of, like me, you're drinking the double espresso rather than the the marshmallow lattes. So maybe you won't hit your personal.
Max, how did you figure that out? How did you know?
No?
Am I that obvious?
I guess, I'm not going to comment on that. But I guess, where I think what we are seeing now globally, even outside of tech, we're actually seeing margins right now over the last couple of months having settled at levels that are higher compared to the peak from before the pandemic, right? Not talking about average levels, not talking about, we might be settling where we were before. No, we're talking about the peak before the pandemic, 2018, 2019. We're now settling outside of tech, really at higher levels than the peak before that. So that is very, very important. So that goes to show the strength even outside of tech. You're absolutely right. I think US small caps are not something that I would want to go for. I would much rather stay in quality. I would much rather stay in large caps, be in tech, and then barbell it with perhaps consumer cyclicals, but on the other hand, also still a bit more on the perhaps industrials, materials, energy side, still overweight oil, for example, because we are seeing a bit more of an uptake in manufacturing activity and leading indicators overall. So that still makes sense. But I do think it's particularly large caps. It is now, as of today, because, again, we have a different starting point. It is tech in particular that should be benefiting the most from it. And, in fact, also emerging markets. When we look at emerging market debt and emerging market equities, look at, for example, typical momentum indicators, typical sort of CTA positioning on the dollar, on US rates, both of them very stretched. So any kind of relief tonight should actually give a bit more of a tailwind also for EM.
How much legs do Goldilocks conditions really have? I mean, basically, is this a month? Is it 2 months? Is this something that could last years?
I don't think it's going to last years. I think what we're really going to talk about over the next sort of 6 to 12 months is we're jumping from one extreme to the other. So that from the start of the year, that sort of notion of us jumping from Goldilocks to reverse Goldilocks, that really still stands. Because at the end of the day, when you look, for example, 4 or 5 months ago, if you had said, look, the Fed is not going to cut at all because inflation actually is back, and, you know, when you look at 3-month annualized core PCE, fine, it's below 2%, but people are making way too much out of that. If you had said that 4 months ago, people could have called you crazy. Now, all of a sudden, if you're saying, well, you know what, the next stage is probably Goldilocks, because, again, the starting point is so different now, it equally sounds pretty crazy, because, of course, now it almost sounds like when you look at all these annualized inflation charts, well, surely we're on the brink of the next inflation wave. But I do think as much as we've exaggerated 4 months ago, we're now exaggerating on the hawkish side. But, you know, that's been a sort of 3-4 month change. So I don't think it's going to be 6 to 12 months stable Goldilocks. It'll be basically flipping to one extreme. Once we've played that, we're basically going to flip it between one extreme to the other.
Max, you talk about risks in your note, and you say you aren't completely oblivious to any of these risks. And so you said one of the recent ones that keeps coming up in conversations is the sustainability of U.S. government debt. But you're not concerned. Why?
Not entirely concerned, not factoring it into the base case, no, because one of the things, for example, look at the US Treasury market, the sheer size of the US Treasury market. If people really are concerned about the sustainability of US debt, frankly, where are they going to go? There is a lack of safe assets, right? So they can't just all go into gold or into Bitcoin. No? So the lack of available safe assets outside of the US, that really calls into question that whole notion around, oh, is the sustainability of US debt really a threat? And on the other hand, also, when we look at government debt, of course, yes, that has spiraled higher, and in particular since 2020. But it needs to be put in context. When we look at, for example, US government debt, compare that to things like household debt in the US. Household debt since the financial crisis has in fact gone down massively. It's gone down very significantly. So when we look at since 2010, for example, total debt, so household debt, corporate debt, and government debt, it's only gone up by around 15% of GDP, which, again, it's not negligibly small, but it's nowhere near as shocking. It nowhere near sounds as dramatic as if you were only focusing on government debt.
Hey, Max, this was great. Brilliant to catch up. Max Kantner there of HSBC. Secretary Yellen getting an absolute grilling in the last 24 hours on this topic. This from Axios this morning. Yellen to warn that threats to democracy would hurt the economy. This story goes on to read as follows. Treasury Secretary Janet Yellen will use a speech to the McCain Institute in Arizona on Friday to deliver a clear warning about the economic dangers presented by January 6-style attacks on American institutions. A bit of detail in the story. In reference to Trump's plans to dramatically increase presidential powers, Yellen will make a broad historical argument with references to East Germany on how autocratic regimes stifle economic growth. She'll also make a plea for the Federal Reserve's independence, apparently, as well. AMH, that's going to be quite a speech, very political for the Treasury Secretary on Friday.
Very political, and we have seen that over the course of her tenure as Treasury Secretary, she's moved from more of an academic to try to tell the company line with the Biden administration, be a little bit more political. I think she really will hone in on the fact that she is a former Fed chair, the fact that Fed independence is paramount, because there have been reporting that's something that Trump would want to undermine. But to Terry Haynes' point recently, he's not going to be able to. This lies with Congress.
We'll come back to that story a little bit later. Equity futures right now negative by 0.5% on the S&P 500. With an update of stories elsewhere with your Bloomberg Brief, here's Danny Berger. Hey, Danny.
Hey, John. Let's get a check on Starbucks shares pre-market. Lisa mentioned this, falling more than 12%. Sales for them fell for the first time 2020. One analyst called it the worst set of results for any large company so far. Other companies from McDonald's, Nestle to Amazon have also flagged more price-sensitive buyers, especially coming from lower-income households. If this decline holds for Starbucks, it would be their biggest drop since March 2020. Well, it's bad news for those hoping to sell a home in the UK. House prices have fallen at the fastest rate in 8 months. The cost of mortgages have crept higher alongside the pullback in pricing for Bank of England cuts. The Nationwide Building Society said that the average home price fell 0.4% in April. Economists had forecast an increase of 0.1%. NYPD officers broke up an escalating pro-Palestinian protest at Columbia University last night. Columbia said the NYPD was called in just after 9 p.m. to restore order. The university's president has asked officers to stay on campus at least until May 17th. Police also made arrests further uptown at the City College of New York. That's your Bloomberg Brief, John.
Danny, thank you. Honestly, what a waste of city resources, Bramo. Just ridiculous.
Well, I heard the choppers over me all night, and basically it raises this question of, how much Mayor Adams is correct about this being something other than just university students.
Yeah. Coming up next on the program, going to leave it there. Amazon's AI bet paying off.
We're seeing cloud projects kick off, and AWS is the king of the cloud jungle. As the leader over Microsoft and Google as it relates to revenue. So you're seeing the flagship cloud business really build.
The latest on the numbers just around the corner, live from New York City this morning. Good morning.
Today, the Fed decides.
Jay Powell pumping the brakes on rate cuts.
Hikes are off the table. No cuts looking perhaps a little bit more likely.
You can't say there's a whole lot wrong with the U.S. economy.
Trust Bloomberg to bring you the fastest coverage and exclusive analysis, including Powell's press conference.
Our policy rate is likely at its peak.
The threshold to cut rates is a little higher.
We're redefining patience.
Bloomberg Surveillance, the Fed decides, starting at 1:30 p.m. Eastern. Context changes everything.
Closing out April with equities lower, kicking off May with exactly the same thing. We're down by 0.5% on the S&P. Check out this name, Starbucks in a pre-market. Lisa brought it up. We are lower by 13%, not on the week, not over the last 30 days, on the session in the pre-market. Take a listen to this, Bramo, on the south side. William Blair, the tide has turned quickly. Jefferies, no easy fix in sight. Citi, putting a lot of oars in the water to try and paddle. Struggling. Stock is down hard.
And people were expecting some sort of turnaround. They didn't get it. Here's my question, and we've been talking about it all morning. Is this about consumer appetite? And we heard this both from Starbucks and McDonald's. Is this because of geopolitics? These are traditionally American names, and overseas, some of their sales have come down. What exactly is the dynamic? Can we take a broader read that's economic, or is this very much a Starbucks and McDonald's problem?
One line that stuck out to me, it said the company is dealing with challenges of one, selling $6 lattes. Not sure who's buying these lavender lattes. That's a different point. But also, customers are balking, especially the younger base, balking at the fact that what their perceived Starbucks of supporting Israel. And Jonathan, you could have moved in Starbucks in the Biden administration.
Yep.
When you're thinking about the struggles this companies have, it's also the struggles this White House is having.
Similar issues. That name is a big mover in the pre-market. We're down by 13%. Under surveillance this morning, Amazon's AI bet paying off.
We're seeing cloud projects kick off, and AWS is the king of the cloud jungle. As the leader over Microsoft and Google as it relates to revenue. So you're seeing the flagship cloud business really build. But at the end of the day, they're still a growth company, and I think that they're investing back into innovation.
It's the latest this morning. Amazon shares rising in the pre-market by 2%. The company's cloud unit posting its strongest sales growth in a year as businesses resume spending on tech and AI. Amazon's saying its generative AI services are on pace for multi-billion-dollar annual sales. Mandeep Singh of Bloomberg Intelligence joins us now for more. Mandeep, can you compare and contrast the numbers from the last quarter and the outlook? Was one strong and one weak?
Well, so I think outlook definitely was weak, but if you parse through the AWS numbers, clearly, they had a sequential acceleration in AWS growth, and the margin expansion was actually quite prominent. My fear over here is they didn't give us enough specifics to kind of have a run rate on generative AI. Yes, it's multi-billion, but how does it compare to Microsoft's, 7% contribution to growth? So with Microsoft, we can see generative AI workloads make up 5% of their overall Azure revenue, which is an $80 billion run rate. Now, granted, Amazon AWS is bigger at $100 billion, but we don't know at what rate that generative AI workloads will grow because, look, they are the incumbent players in cloud, and they have to invest more in CapEx to drive the generative AI chips in their data centers. So that's the risk with Amazon is you may need more CapEx to refresh your data centers, and it's going to eat up your margins. I think we probably have seen peak AWS margins in a while, and I would be surprised if they keep showing margin expansion on the AWS side.
Which is the reason why you're not seeing a bigger pop in the shares, maybe, given the fact that they did see their strongest growth in the cloud services business in about a year. I feel like Amazon epitomizes this earnings season so far. AI-related stuff, great, going gangbusters. Anything dealing with the consumer, not so much. How much do you take a message from that, this idea that this isn't just an Amazon problem, this truly is something that's economic that they're getting hit with too, in terms of their actual sales platform to the average consumer?
I mean, look, they have a platform where they serve so many different types of, consumers that clearly the Prime bundle has its value proposition. I think, again, if there's one subscription you want to keep as a consumer, it's Amazon because of so many services that they deliver. But clearly, you're right. I think you could see that in the print that, it's hard to see margins expanding even on the e-commerce side simply because they have pulled all levers around cost optimization, doing whatever they can in terms of layoffs, et cetera. So I think the margin side is where I'm most concerned because AWS was basically the margin expansion story when it comes to Amazon. And it's not able to subsidize the other businesses anymore going forward, given it's got its own CapEx. And I think that's the part that investors need to parse out.
Mandeep, what happened to the dividend? It didn't come.
Yeah. Well, it didn't come. And I think that's where, again, you have to question the capital allocation. They said they are in a multi-year CapEx investment cycle. So it's very similar to Meta, albeit, with Meta, everyone didn't like the Reality Labs investment. In this case, they're also saying it's a multi-year investment CapEx cycle. And there wasn't any, answers around dividends or buybacks. And Amazon, in its history, has rarely done big buybacks. I mean, this has been a top-line growth story, and it's been amazing. I mean, you could argue by the end of the decade, they could be a $1 trillion revenue company, but it's the margins part that people are unsure about. And I think right now the uncertainty has gone up given the CapEx investments required for generative AI.
Mandeep, just before we run, you can break this company down between corporate spending and consumer spending. Is one a whole lot more resilient than the other at the moment?
Well, so Amazon is skewed towards small businesses, even on the corporate spending side. And obviously the consumer side is also a focus on, kind of small consumers as well as consumers of all sizes. But on the enterprise side, I would argue they are not as resilient as a Microsoft is because Microsoft is more skewed towards large enterprises, which is more recurring in nature. They're not going to dial back their spend as quickly as the small businesses are. So I do think there are more risks to Amazon cloud growth than there are to Microsoft.
Interesting. Fascinating framing. Mandeep, thank you, sir. Mandeep Singh there of Bloomberg Intelligence. Brahma, what do you think of that framing, large versus small?
This is the reason why Amazon maybe isn't getting the same kind of reception, even though they had the strongest sales growth in a year. It also shows how Amazon is that much more vulnerable on two prongs, both with their customer base in the cloud services computing section, as well as just the basic sales for the average consumer who doesn't want to buy clothes anymore on Amazon or toilet paper, who doesn't like getting big shipments that they have to pull up from.
Is this personal?
No,
Again, not at all.
I'm just saying, other things. Garbage bags.
Consumer confidence down yesterday. Not great. Small business confidence, not great either.
People are feeling the pinch, right? And we've been talking about this extensively, that there is this cumulative feeling, which raises the question of just this uncertainty. Is it big versus small? And we're going to just keep seeing that in earnings.
Amazon up by 2%. Bramo sick of buying toilet paper from there, apparently.
Well, I mean,
not personal.
It's a lot of packaging.
Sure.
You just can go and get some, It's like you get these huge packages, boxes
Super
that are wasted.
Inconvenient. Totally agree.
You pull it, I
hate wasting boxes. Feel exactly the same.
You can recycle them.
I can't stand it. It really frustrates me, putting the boxes out. Oh. First world problems, Bramo. Leaving behind the worst month of the year for US equities. Good morning to you. Equity futures right now on the S&P 500, negative by 0.5%, down by 0.9 on the Nasdaq 100, down 4% on the S&P in the month of April, snapping a 5-month winning streak. And the bond market, quite a run. It's been stocks down, bonds down, yields up. And we've been plagued by higher than expected inflation. CPI, PPI, and yesterday, ECI. Yields back through 5% on a 2-year, 5.03% on a 10-year, up by almost a single basis point this morning. And Lisa making another approach, another look at 470, 468.83 on 10s.
With people pricing out any rate cuts until December now for the Federal Reserve going into that meeting later today. Here's the issue that we've seen complete disagreement with on this show, which is essentially, can this equity market sustain its rally given where yields are if they stay here? Or is it going to hamper it going forward? We don't get agreement with that. Honestly, are we in a rolling Goldilocks or a rolling recession? And frankly, you can't get two people to agree.
And what does it mean if you throw a stronger dollar into the mix as well? Switch at the board and go to that. So yields have moved at the front end of the curve. Big repricing of more than something like 40 basis points at the front end of the curve in the last month or so. You push that through the FX market, you get a much, much stronger dollar. And if you can look at dollar yen just for a moment, 157.88. So the yen is on the worst monthly streak going back to 2014. And you would argue that back then, more than a decade ago, this was something the BOJ was trying to engineer, yen weakness. This is not something the BOJ is attempting to engineer this time around.
Although it's unclear how concerned they are about this. And arguably, one of the reasons why you have seen such a sell-off in the yen is because the Bank of Japan didn't seem overly concerned about it at their meeting and didn't take a more hawkish stance, saying that they were going to raise rates. They were watching it, but it wasn't their main thing. So to me, it raises this question, well, if they're not that concerned about it, at what point does it really hamper the economy with the bad type of inflation that's imported? And that really isn't helpful.
That's why I think intervention is so much harder. It doesn't feel like the BOJ and the Ministry of Finance are on the same page.
But that's exactly
At
it.
all.
And honestly, until the Bank of Japan gets on the same page, can you actually get a sustained rally in the yen?
157.88 on dollar yen this morning. Under surveillance today, the Fed rate decision due out at 2 p.m. Eastern time. The central bank expected to keep rates steady for a 6th consecutive meeting. Fed Chair Jay Powell likely to make a hawkish pivot in his news conference following a series of hotter than expected inflation prints. A conversation we'll have with David Rosenberg a little bit later this morning. Hawkish relative to what? That's the most important market question I think we have going into this news conference. Is it relative to the last meeting or relative to what is already priced in the market? Because as we said at the start of the programme, Bramo, one is a much higher bar than the other.
And it really goes down to, does he want to engineer a sell-off? Right. This hasn't been a Fed chair that has shown any particular proclivity toward hawkishness in any of the recent meetings. You showed the Alan Ruskin stat. Here's really the issue for me. Does he view the pivot back late last year as a policy error? And that's what a lot of people have been saying. And if he does he want to reverse it by saying, yes, hikes are on the table, engineer a sell-off that could potentially move them closer to their goal?
Well, Earl Davis will be joining us later, and he talks about a partial Fed pivot that Jay Powell is going to try to conduct today. And basically that means leaving some optionality open for July and September easing, but acknowledging that that window is starting to get very narrow.
Decision at 2 p.m. News conference 30 minutes after that. Look out for that this afternoon. Elsewhere, Tesla announcing more job cuts. The company eliminating almost its entire supercharger organization, which has built a vast network of public charging stations that virtually every major automaker in the US is tapping into. In a post on X, Elon Musk said this: Tesla still plans to grow the supercharger network, just at a slower pace for new locations and more focus on 100% uptime and expansion of existing locations. If you are a major manufacturer that's started to make the shift to be able to use this network, Lisa, what are you thinking this morning?
Well, we know Rivian, Ford, GM, They're angry. I could use some other words. They are not very pleased because they're actually adapting their technology to cohere with some of these chargers. So here's a question. How much does Elon Musk hold the keys to the entire electric vehicle adoption in the United States? And if he does, is he basically just sort of flipping off the entire industry right now?
Reading some of the reporting and some of the statements made by some of these companies, they are blindsided. This was a huge win for Tesla. They were coming onto their charging networks. But you have to think of what Musk said in this report from The Information, quote, we need to be absolutely hardcore about headcount and cost reduction. Well, this is hardcore.
So it's not just the US manufacturers, it's the Europeans as well. So Volvo, Kia, Honda, Mercedes, BMW, Europe, Asia, take your pick. I wonder if, reading between the lines, there's a little dear White House, dear Brussels, come on board. If you want us to do a little bit more, hire more people to roll this out, we can help, but we're going to need a little bit more.
Especially with the juxtaposition of his visit to China, especially given the fact that they're over there trying to get the nod from Xi Jinping. They're basically saying we're not going to provide the infrastructure unless we get some sort of nod. You're correct. I do think it's not a coincidence that both of these things happened.
Yeah, I did wonder when I saw the story in the last 24 hours. Let's turn to this. US Secretary of State Antony Blinken renewing calls for Hamas to accept a ceasefire deal in a meeting with Israeli President Isaac Herzog. Blinken saying this, even in these very difficult times, we're determined to get a ceasefire that brings the hostages home and to get it now. And the only reason that wouldn't be achieved is because of Hamas. Joining us now for more, Stephen Cook, Senior Fellow for Middle East and Africa Studies at CFR and author of the upcoming book, The End of Ambition. Stephen Cook is with us now. Stephen, let's go to the first question, sir. A question we've been leaning on over the last 24 hours or so. Are we actually close to a deal between Israel and Hamas or not?
It doesn't seem like we are very close, although the reporting would suggest otherwise. The problem is that Hamas would have to give up the one piece of leverage it has in this conflict, and that is the remaining Israeli hostages, especially since the Israelis have not been willing to commit to an actual end of the conflict. There has been some talk of a sustainable calm over perhaps 3 months, but the Israelis are determined to finish this conflict the way they started it, which is destroying Hamas's ability to threaten Israeli security. There's really no indication that the Israelis have given that up. As a result, the Hamas leadership, particularly the Hamas leadership within the Gaza Strip, doesn't see any reason to really move forward in this ceasefire for a hostage deal.
When do you then see Netanyahu directing the IDF to go into Rafah?
Well, that is a more difficult question, although the IDF has recently indicated that they're fully ready to go into Rafah. It's important to note that the prime minister has said whether there is a hostage deal or not, Rafah is going to happen, which puts him in direct conflict with the president of the United States, who has continued to say that he does not support a Rafah operation. The real issue in Israel is that there is significant political support for going into Rafah, and to not go into Rafah potentially breaks Netanyahu's coalition. So I think it's quite likely that there will be some type of operation in Rafah. The Israelis are saying they're ready. That may just be a negotiating tactic here, but nevertheless, I would expect it at some point.
So even if we do get a deal, you do expect Netanyahu to go into Rafah. But how much time could a deal potentially prolong that decision from Netanyahu?
It certainly can prolong it well into the summer months or even into the fall. The leaked documents about this potential deal talks about 100 days of a ceasefire. An initial 16-day ceasefire in which a larger number of Israeli hostages would be released in exchange for Palestinian hostages, and then 2 42-day periods of calm. So if it happens, it could delay the Rafah operation a number of months. But the Israelis seem determined to not go back to the status quo ante.
How much do the protests that we see across universities in the U.S. and frankly also in the Middle East and Europe really prolong the conflict in the sense that it makes certain members of Hamas less likely to really accept a ceasefire?
I think it has a dynamic effect on both sides. These protests are being covered wall to wall by the Israeli press. We have seen Hamas figures and Hezbollah figures praising university students. So the Hamas and its allies believe that they have the momentum of global public opinion behind them. The Israelis feel more and more isolated and feel like they have less and less to lose by going into Rafah. They'd be damned if they do and damned if they don't. So I do think that it has a dynamic effect on the ground in terms of prolonging the conflict.
What do some of the Arab allies of the United States, and probably secretly of Israel, think about some of the protests that are going on in the United States? And I'm thinking, for example, of Saudi Arabia, as well as Jordan, as well as Egypt.
Well, it's undoubtedly the case that they understand that the politics of Israel and the United States may very well be changing as new generations come into positions of authority in the United States. But they are really focused on bringing a ceasefire and an end to this conflict. So the protests on college campuses is an interesting sideshow. I will note that in addition to the Israeli press, Al Jazeera is also covering this wall to wall. But Arab officials are more concerned actually with the state of affairs in the Gaza Strip and what will come next, and whether there will be, in the words of American officials, a concrete, time-limited, credible path towards a Palestinian state. The protests, from their perspective, are neither helpful nor hurtful, just an interesting side story to the overall conflict in the region.
Stephen, do you believe the end game is still the same, that Israel will probably end up reoccupying Gaza?
It's hard to see how they are not going to. The plans for the day after remain essentially what we've been talking about since October, November, which is a revitalized Palestinian Authority, and with the help from major Arab partners of the United States. The problem is that none of those parties actually had the capacity to maintain calm in the Gaza Strip at the same time rebuilding it, while they have also requirements that there be a credible process towards a Palestinian state. That leaves the IDF there to provide, quote unquote, overall security, in the words of Israeli officials. And then let's add into this mix the radical right in Israel, which has a potent political argument about settling the Gaza Strip. In 2005, they said if Israel withdrew from the Strip, there would be all kinds of security problems. After October 7th, that argument makes more and more sense to people. And there's a fairly significant number of Israelis, according to polls, who would support resettlement of the Gaza Strip. So this is by no means something that is going to end with a ceasefire and hostage agreement, or even if the Israelis call off a Rafah operation.
I wonder where this would leave President Biden's position, Stephen, if we could focus and end on that. As we talked about, as we discussed, college campuses are a mess. Biden is losing the youth vote. We can see that in poll after poll. I think we're trying to work out whether the president's domestic political struggles will reshape his view of America's role in the Middle East. You've written about it, America's future role in the Middle East. Stephen, how will it shape that? Not just for this presidency, but maybe for future Democratic presidencies as well.
I think the president, you can trace back everything to his bear hug of the Israeli government, which the Israelis interpreted as giving them license to prosecute the war however they pleased. I think President Biden and his advisors believed it bought him the ability to influence those military operations. Now the United States seems to be going down the road of a big, ambitious project to build a Palestinian state. And we know how that has worked out over the previous 3 decades. It's likely to end in failure, and it's likely to be blamed on the United States. I think the United States needs to lower its ambitions for what can possibly be done in the Gaza Strip. And the first priority is to make sure the Israelis don't reoccupy it and don't resettle the Gaza Strip.
Stephen, appreciate your perspective, sir. Thank you. Stephen Cook there of CFR and author of The End of Ambition, America's Past, Present and Future in the Middle East. Let's give an update on stories elsewhere. Let's get your Bloomberg brief. We can do that with Danny Berger. Hey, Danny.
Hey, John. Johnson & Johnson is hoping a bigger payout will resolve ongoing litigation over its allegedly tainted baby powder. The company is set to ask thousands of people suing it to agree to resolve the claim for $11 $11 billion. That's $2.1 billion increase to offer it made last year. In a release this morning, J&J urges those who blame the talc-based powders for ovarian cancer to support a third bankruptcy filing aimed at settling all current and future claims. A luxury cruise IPO is likely to begin trading this morning as Viking Holdings. They raised over $1.5 billion, pricing near the top end of its range. The company and its investors are offering shares for $24 apiece. The IPO, it will create a neat little $5 billion fortune for Viking's founder, who's focused the business on wealthy customers and no kids. GM CEO Mary Barra told Bloomberg's Emily Chang why she's betting big on electric vehicles and autonomous driving, technology that she says will be crucial to the next era of cars.
I think it was overhyped, and now it's probably underhyped. And the truth is somewhere in the middle. But, again, yes, growth has slowed, but it's still growing.
The Circuit with Emily Chang airs tonight at 6 p.m. Eastern in New York. That's your Bloomberg Brief. John.
Danny, thank you. The Circuit's had a brilliant start. Looking forward to more of that a little bit later. Viking Cruise. Okay?
Yeah.
The one cruise I might consider going on.
River
Just
cruise.
the one.
Where
Just
would you
a
go?
river cruise.
Where would you go?
With my parents.
Don't know. Somewhere in Europe, okay?
Go down to Croatia.
Is that something you'd like to do?
It's
Team trip?
Team trip to Croatia.
TK's been trying to make this team trip happen for a while.
A small river cruise down the Croatian coast could be really beautiful.
I wouldn't go on Icon of the Seas. You couldn't pay me enough money. But if TK is willing to pay for a Viking river cruise, I might get on board.
We can discuss that later.
I can handle that. Up next on the program, when bumps become a trend.
It would take something like an acceleration in inflation from where we are and a continued acceleration through the year to really get that conversation on the table of raising rates.
The brilliant David Rosenberg just around the corner from New York. This is Bloomberg. Kicking off May with equities lower by 0.4% on the S&P 500. Just a bit of a pullback building on last month's losses. In the bond market, yields just about unchanged, almost up a single basis point on a 10-year 468.83. Under surveillance this morning when bumps become a trend.
For the Fed, they do feel they're restrictive. They would rather just hang out at these levels for longer than have to raise rates again. I think it would take something like an acceleration in inflation from where we are and a continued acceleration through the year to really get that conversation on the table of raising rates. I think he'll still say that they feel they're restrictive.
Here's the latest. Fed officials expected to hold rates steady for a sixth straight meeting today, with traders preparing for a possible hawkish pivot from Fed Chair Jay Powell at his news conference. David Rosenberg of Rosenberg Research writing that what hawkish now means relative to market pricing isn't what it once was. Powell seems to be moving away from his earlier view that the inflation pickup in the first 3 months of the year was due to mostly some statistical aberrations. That said, I still believe that this inflation deviation from the second half of last year is going to be corrected. David is with us right now. So, David, two-part story. I'll get to that aberration in just a moment on inflation. I want to start with this hawkish shift. So many notes we've all read have said the same thing. A hawkish Chair Powell in the news conference. I think you've absolutely nailed it. Hawkish relative to what? Because hawkish relative to the last meeting is a pretty low bar. Relative to what's priced is a different story. How hawkish, David, is this going to be?
Well, I think at this stage, for Powell to sound hawkish enough, I think, to move Treasury yields higher, he'd either have to strongly suggest that all the rate cuts, and there's really only one and a bit left for the year, they're just off the table. Or for sure, he's going to be asked at the press scrum as to what his view would be on the possibility of the Fed actually moving towards raising rates again. And if he doesn't push back on that, that could be a very important market mover. But that's where we are right now. We're no longer with the bar set at 6 or even 3 rate cuts, which were in the last set of dot plots. So I would say that he's going to have to sound hawkish enough that either there's no rate cuts coming whatsoever, or the prospect that maybe the Fed's next move is going to be to hike. And there's some market chatter to that regard over the course of the past several weeks.
David, I want to go to the second point that John was talking about. The first being, hawkish relative to what? The second being, you still believe that disinflation is coming down the pike and that the recent data that we've seen that's been harder than expected has been an aberration. What gives you such confidence?
Well, I don't know if I really have a crystal ball as to, how long we're going to be seeing, auto insurance going up at a 20% annual rate. If we go back to 2021 into 2022, the poster child back then were used cars and car rentals, and they were just soaring to the moon. That didn't last forever, right? So we have auto insurance, we have tenant, homeowner insurance, financial services, and of course, what's been frustratingly slow is the descent in the dominant rental measures. But the reality is that when you're looking outside of these factors to show how bifurcated the story is, and people will say, well, this is data mining, but it's really just to identify that there's a real split in the data. Because when you actually move away from insurance premiums, which is not really about the economic cycle and the arcane way that the rents are treated, financial services, well, broker commissions and the like, well, that's related to what the stock market's been doing up until recently. But everything else collectively is running around 1.5% on a year-over-year rate. So if you can build a straw man that these factors that precipitated, the bump up in inflation January, February, and March were due to these, what are still idiosyncratic and isolated components of the CPI and PC deflator, and then we can possibly revert to the pattern of the inflation data and the core inflation data in the second half of last year. I think the Fed's going to be quite a bit more comfortable as we move to, I would say into the July meeting. The numbers are going to look quite a bit differently.
David, yesterday we had a surge of employment cost index. We also had a reacceleration or acceleration of housing prices. And then the Conference Board, when you look at consumer confidence, is the lowest since July of 2022. How does Powell deal with this barrage of pretty bad data just within the last 24 hours?
Yeah, again, some huge divergences. What was interesting in the employment cost index was when you're taking a look, for example, at areas like financial services, they weakened off quite a bit. Retail was actually down, which was a big surprise considering the minimum wage increases in California. And leisure hospitality, of course, which is what Powell was focused on just a year and 2 years ago as signs of mismatch in consumer cyclical services, that also slowed down dramatically. A lot of that ECI, again, was highly concentrated in state and local government and manufacturing. We saw a bulge, even though it's interesting, manufacturing, we know, look at the Chicago PMI yesterday, or look at all the aggregate data in manufacturing, the industrial sector is indeed in a recession of its own, and yet manufacturing was a leader in the ECI. Why? Well, because we started to see the initial impact of those UAW settlements kick into the data. Again, that was not a broadly based report. That is not something I'm going to point to and say, well, we have some massive wage inflation going on in the U.S. economy. It was really, once again, a big divide between, some of the more private cyclical services areas, which actually 2 years ago were a big source of a problem. They're starting to slow down. And you mentioned about the Conference Board survey, the Consumer Confidence Survey. It was very interesting because the first thing you think about with such a big decline in consumer confidence in April was that, well, that must be because of inflation. But actually, the 1 year inflation metric stayed the same at 5.3%. It wasn't inflation. Do you know what the weakest component of that report was? Was the assessment of households on the labor market, both currently and the assessment over the next 6 months. And I'd have to say that if that assessment on the jobs market is accurate, it's going to be tough for people to go to their boss and negotiate for higher pay packets. So again, I'm looking at what happened with the ECI in the first quarter, again, as something that's not going to be sustainable.
So David, just quickly, what would you say to people throwing around the stagflation word in the last week or so? What would you say back to them?
It's ridiculous. Okay, stagflation. What I mean, we have a 3 handle on inflation. Do you know that when they talked about stagflation in the 1970s, if you describe today's situation back in the 1970s, anybody who was around back then, you'd be a laughing stock. But people just throw around these words without even understanding what they are. I do think that we have a stagnant economy, and it's not evident really in the government data, but there's not a snowball's chance in hell that you can read the last Fed's beige book. The beige book's been around for over 50 years.
Yep.
And it was replete with signs not of a recession, but of an economy that's pretty well flat on its back. It is not comporting a lot of the other data that you've been seeing on the real side of the economy. But what's most important was what we're already seeing out of places like, Walmart and Starbucks, is that across a broad array of the retail sector, companies are losing pricing power. So where's the inflation in that? Yeah, there's inflation in that. It's called disinflation. And that's what we'll be talking about 6 and 12 months from now.
David, you're one of the best. It's fantastic to catch up with you, sir. David Rosenberg there of Rosenberg Research. We heard that from Walmart executives almost on repeat over the last few months. Speaking of Walmart, just some difficulties around the healthcare story and retail.
Yesterday we heard, or a couple days ago, we heard about Walmart closing health centers and telehealth units due to rising costs. This morning we're seeing CVS tumbling. They cut their full year forecast because of, guess what, rising costs associated with some of their foray into healthcare. So it seems like there's some trouble there.
Stock is down by 12% in early trading. Coming up next in the second hour of Bloomberg Surveillance, Tony DeSpirito of BlackRock, Bloomberg's Mario Parker, Vasilios Giannakis of Aviva, and Earl Davis of BMO on why this 10-year he thinks could test 5%. That's coming up shortly. This is Bloomberg.
Earnings season has been going well enough, not awesome, but pretty good. And so obviously right now that's the focus.
Earnings by and large are not great, but okay enough.
We are starting to see in some areas a few cracks.
Not all of these companies can navigate high for longer the same way.
All of the earnings growth is 5 stocks again, but I think that's going to change as we move through the year.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Stocks down, bonds down, yields a whole lot higher. Good riddance, April. Hello, May. And standing in the way of gains on the first day of May, a Federal Reserve meeting just around the corner. Equity futures negative by 0.4% on the S&P 500. On repeat, we have heard a hawkish Chairman Powell is coming to you in the news conference. Bramo, how hawkish?
And hawkish compared to what, as we were just talking about with David Rosenberg. Is he going to come out with any conviction saying that there has been a material shift in the trajectory of inflation? Or is he just going to say that there isn't the same degree of confidence that he was hoping for to essentially connect the dots, cut rates in June?
Would he gain confidence or lose confidence was the question we asked after the last news conference. Arguably, he's lost some. This is what I want to understand. Do they acknowledge that the disinflationary process has stalled? Do they acknowledge that in the statement? Do they acknowledge that in the news conference? Or are they still referring to this as bumps in the road?
It's a great question. And basically, it comes down to what do they want the response in markets to be? Because you have to imagine that Jay Powell is savvy enough to know if he says that this has been a stalling out of disinflation, that will be read by a materially more hawkish Jay Powell in the market, and it will incur some sort of sell-off. So does he want that or not, I think, is one of the key questions.
Claudia Sam put it well. When he opens his mouth, there's going to be downside risk. If they admit that this isn't just bumps, then what was the point of the pivot they made in December? And I think that's why he has to come out and say we are still monitoring this data, and at the moment we do see disinflationary trends.
At 2 p.m., the decision just around the corner. 2:30, the news conference. 30 minutes later, the price action going into it looks like this. Equities are lower by 0.4% in the bond market on a 10-year, approaching 470, 468. The move we've seen in the last month, unreal, both at the front and the long end. At the front end, we've had a move of about 40 basis points. At the longer end, something around at least 50 basis points higher on a 10-year. And against that, equities lower and down about 4%.
So I'm going to say something that I don't normally do, which is at this point, I'm not as interested even in bonds as I am in what's going on in specific stocks and what that says about where the economy is, because I'm not getting a clear read on things. Basically, yeah, there's this question of, can companies sustain themselves on these yields where they are? But then you start looking into which companies are doing what. And we talked about Starbucks, we talked about McDonald's, we talked about Amazon away from AWS. There's clearly pressure. There is clearly a sense that they can't pass on the same kind of price increases to consumers. So how do we pair this with this idea that other places are seeing real growth and we're seeing a sort of rebound in inflation? This is what I'm struggling with.
Well, let's go to Starbucks and let's put the name up on the screen. In the pre-market, down something like 12% through most of this morning. We touched on some of the Southside research earlier on. Southside research on Starbucks today is pretty brutal. The takeaway, stunning across-the-board miss. A stunning across-the-board miss. The name is down about 13%. I referenced some of the work from William Blair. The tide has turned quickly. From Jefferies, a notable miss. The likes of Citi. This quote from Citi I've read already. It's worth repeating, Lisa. Starbucks is putting a lot of oars in the water to try and paddle. Struggling to move.
And part of this is just a reset that isn't working, right? Part of this is just a lot of competition with respect to how much you can possibly pay for a cup of coffee that has some milk in it. And then there's a question of, protests of American brands, particularly Starbucks and McDonald's, due to the U.S.'s backing of Israel with respect to what's going on in Gaza. My bigger question is, it's not just these. We also heard that from Amazon in their retail unit. So clearly there's something bigger going on. And you put that with the beige book, and it's just a really unclear picture.
When I look at Starbucks, the one line that stood out to me yesterday, because since January, I've been talking about their pricing power or the lack of in China. China comparable sales down 11%. Estimate was for 1.6%. The same kind of issue with EVs. The price cuts you're seeing in coffee in China. Starbucks, even though with this brand that they have in China, it's not working.
Is it a problem with US brands, which is kind of what you were alluding to just moments ago?
And this is kind of what you're seeing in certain places, that multinationals, and you've been asking this for a long time, are multinationals benefiting from the diversification overseas, or are they suffering from not being highly leveraged to the American exceptionalism and being vulnerable to some of these international pressures?
It's not as easy as it once was. Choppy waters internationally, stronger dollar in the mix as well. The stock is down by something like 13% in the pre-market. Coming up this hour, Tony DeSpirito of BlackRock, with stocks snapping 5 months of gains. Vasilios Giannakis of Aviva on the dollar strengthening ahead of the Fed decision, and BMO's L. Davis looking for the 10-year yield to test 5%, which, let's be fair, is only 30 basis points away. We begin with our top story. Markets on edge ahead of the Fed decision. US equities closing out a difficult April with the worst day since January. To discuss, Tony DeSpirito of BlackRock joins us now for more. Tony, you describe yourself as actively bullish. Could you help us understand what that means in practice?
Sure. So, John, what I mean by that is, in terms of the market, I'm pretty positive, right? I think we're in a decent setup. We've got earnings that are growing quite nicely for the first time in a while, right? So, right now estimates are running a little above 3%. By the end of the quarter, by the end of the reporting season, we should be close to high single digits, close to double digits. So I think the economy, I actually think, is doing well. Yes, there's some bumps along the road, but generally the trajectory is quite positive, earnings growth quite positive. So that's good for the market. But where I get really excited is the opportunity for active management. And I think about that as it's skill times the opportunity set, and the opportunity set is dispersion. And right now, I see a lot of dispersion. I mean, I've heard you talk about that this morning. Some companies doing really well, some companies doing really poorly, very big differences in valuations amongst companies. To me, that's a stock picker's paradise. And so that's why I use the word actively bullish about the markets, but particularly bullish about the opportunity set for skilled active managers in this market.
Tony, what do you make of these big moves that we're seeing? Peter Chia of Academy started the week by asking whether 10% was the new 1%, just in terms of intraday moves post-earnings for mega cap names. What do you make of some of these moves? Just double-digit moves here, there, and everywhere.
Yeah, so you're right. The moves have been quite large. I mean, part of that's like, look, the market has changed a lot. Even though we had a tough April, the market's still up 20% since the October lows. It's still up 6% year to date. And so I think, yes, there's some volatility under the scene. Again, volatility is good for a skilled stock picker, but generally the trajectory of the market is still quite nicely up.
Some people were talking about a rolling recession that's basically cleaned out certain sectors. And then we heard from Max Kettner, essentially, that it's been a rolling Goldilocks, and that basically you just have to lean into this Goldilocks narrative. Is that what you see, a rolling Goldilocks that's sort of going through different sectors that right now is highlighting and putting a halo around AI and energy, and will roll somewhere else pretty soon?
Yes, I wouldn't use the Goldilocks word, but I do see this rolling, recession recovery, so to speak. And I think that's a lot to do with the dance of COVID, the push and pull, where we've seen, chip shortages than chip surpluses, for example. We've seen, step changes in inflation, auto costs, insurance, et cetera. And so all that's created this, as you put it, this kind of rolling recession. So 2022, really tough year for technology companies. They responded by cutting costs. And then, 2023, you have a better cost base and improving revenues, and you have an earnings, explosion, a positive earnings explosion. When I look at the market right now, the market's very concentrated in this Magnificent Seven, so to speak. And if you look at the earnings estimates, the Magnificent Seven earnings growth has been quite high, a lot higher than the rest of the market. And the valuations reflect that. What's interesting is if you look out at quarterly earnings estimates, by the end of this year, the estimates for the Mag 7 versus the rest of the market basically normalize, they equalize. And yet you're paying a lot more for the Mag 7. Now, I think the Mag 7, the earnings will probably come out a little better than what the estimates are, but still, it'll be pretty close to equal. And I think that goes, again, to this idea of the market broadening out and that being an opportunity for stock pickers. And I think we will see that over the next, several quarters.
How challenged is this broadening out thesis, not just from the Fed holding rates where they are, but this idea that we're seeing a consumer that does seem to be pinched? I mean, we're talking about Starbucks, we're talking about McDonald's, we're also talking about Amazon, apart from AWS, highlighting a real slowdown in terms of online purchases. How much do you see that as really hampering an ability to broaden out at a time where there really is a two-speed economy, where there is a growing number of people really struggling?
So I actually think that's a healthy part of the process. What we're hearing when I speak to individual company CEOs, et cetera, what I hear is a consumer being more selective. And I think that's a function of this step change, so to speak, in prices that we've seen. And I see that as a good thing because when I look at consumer spending and consumer savings, I see a consumer that's been spending at an above trend rate, meaning the consumer savings rate is too low. It's hovering just over 3%. Normal is much more like 6%, right? And so I like the fact that the consumer is getting a little bit more selective, a little bit more conservative. I think that's good for the long run. The other positive I see that we haven't talked about is just productivity growth and population growth. Both of those have surprised positively, and that's also helping to sustain the economy, even though the consumer is being more conservative.
Tony, you spent a lot of time on your note talking about the election and the fact that actually companies aren't talking about it, even though many are saying that this is the most consequential election in our lifetime. Is that just because these two individuals are known knowns?
Yeah, it's pretty interesting, right? Because we've gone back since the elections going back to 2012. And using our AI techniques have gone back and read through effectively conference call transcripts. And companies are talking less at this stage. Now, we would expect it to increase as we get closer to the election, but fewer companies are talking about the election. I agree with you. I think it's largely because we have two known candidates. And I don't think we also are going to have, I think no matter how it comes out, we're going to have a lot of close calls, whether that's at the presidency, whether that's at the House or the Senate. Yeah. And so I think that means not big policy changes from here.
I think they all understand the pitfalls of talking about politics now as well, Tony. Tony, it's good to hear from you, as always. Tony DeSpirito of BlackRock there, actively bullish. Talked about this in the last hour. Just getting confirmation of it now from the Treasury. The Secretary of the Treasury, Janet Yellen, will travel to Arizona on Friday to deliver a major address on the economic case for democracy. This is going to be an interesting one, Annmarie. So basically, this is going to be a speech, and it's my framing, not theirs, which essentially takes on some of the ideas of the former president running to be president for a second round without actually naming him.
Nope, and she's going to basically tout what the Biden administration, the Biden campaign is trying to talk about, that this election is about democracy versus autocracy. Also, it's interesting, this comes on the heels of the former president, Donald Trump, sitting down with Time magazine, a very long and extensive conversation. And he was asked yet again, as he's been a number of times, about that quip he made about being a dictator on day one. And he said, look, I was just joking. But he did get into a number of economic policies that jive that are very different than what this administration is trying to put forward.
I mean, honestly, the idea of Fed independence, he kind of put front and forward, right? And there's been a lot of discussion around that whole idea, possibly, of him being able to have veto power, the feasibility of it. But even sort of middle-of-the-road types of columnists, Tyler Cowen, for example, of Bloomberg Opinion, coming out and saying Trump's Fed plans make no sense even for him. Other people questioning how realistic this is or whether this is some of his advisors kind of pushing him in one direction or another. How much is this Yellen acting as a proxy to President Biden to try to make a cohesive argument against this in a way that can appeal to possibly the business community that hasn't necessarily picked a side yet?
The short answer is a lot. I'll say that, a lot. I'll go on to say this because it's TV and we should speak for longer because we've got to get to a certain time. So a lot.
You're crushing it.
Thank you.
Yeah.
Does this poll well? This is what I'm thinking about. You know, the president did an address at the White House Correspondents' Dinner on Saturday and talked about some of these themes, and then the comedian afterwards, some of you might say so-called comedian afterwards, basically finished with an endorsement of the president, also on a similar theme. Does this poll well? Because so much of this stuff, to me at least, sitting here, is very well known, well understood. I get that one person stands for this, I understand that one person stands for that, and then I look at the polls and I'm like, okay, well, still behind in swing states. Does this poll well?
Well, it hasn't really been done before. You never had a president come out and say, this is what my agenda is going to be about. What has polled badly for the president is the fact that people are still feeling inflation. And we continuously see that. We saw that in our most recent poll of swing states, and we saw it most recently in the CBS poll looking at all the blue walls, that people are still feeling the economic pinch of higher prices and inflation. And that is what is hurting Biden's poll numbers right now.
But wasn't Biden just running as the anti-Trump? And they sort of, political careers of both of them kind of are tied to one another?
Sure.
And that's essentially...
They're married politically.
What I'm asking is he's trying to make this election about the future of democracy. We all understand that. Haven't we all got the message? That's what he's trying to make it about. I'm trying to understand whether that's actually polling well, because based on the polls I've seen, not so much.
I get the sense a lot of people are tuning it out, and I get the sense that a lot of people are tuning out highfalutin rhetoric on both sides because there have been a lot of accusations thrown back and forth. It's a good question. Right now, it seems like everyone's just going la, 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 la. I hope it's going to end.
I'm with you. Great TV. Let's get you an update on stories elsewhere this morning. Here's your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. Quick check on Amazon, up 2.2%. As you were discussing, its cloud unit did post stronger sales in the year, but its push into AI for AWS has come at a cost. The CFO saying that CapEx will meaningfully increase this year. Now, as for the e-commerce side of the business, Amazon's forecast fell short of estimates, but e-marketer's Blake Drosh told me earlier this morning that Amazon can capitalize off of price-sensitive buyers.
Consumers don't necessarily stop purchasing these products. They trade down. And Amazon is another thing that they've done last year is they've expanded their consideration set. So consumers who are looking to trade down can find cheaper options and still access that fast and free shipping.
Now, some new details for you on Microsoft's big spending into AI. The company's decision to invest heavily in OpenAI stemmed from concerns about falling behind Google. Those details came from an email. It was released yesterday as part of the DOJ's antitrust case against Google. The DOJ is currently arguing that OpenAI's ChatGPT and other advanced tech could have been released years ago if Google hadn't monopolized the search market. Harvard economics professor Ken Rogoff says financial markets will thwart any political pressure on the Fed. Earlier this week, as you were just discussing, reports suggested that Donald Trump's advisors are drafting plans to give Trump more control over the Fed. Rogoff spoke with Bloomberg yesterday.
If you take away Fed independence, investors are going to get jittery, inflation expectations are going to go up, the dollar's going to tank. So happily, for better, for worse, maybe, I think markets will throw a pretty cold bucket of water on the president if he tries to do that.
That's your Bloomberg Brief, John.
Thank you, Danny. Thank you very much. What did you say, Liz Truss moment?
That's essentially what he's describing.
Yeah.
Dollar tanks, yields go up. Market says, nope, not gonna have this.
In the first term, the markets were sort of like a limit on the president's ambitions, and then he'd back away. Do you think that's going to be the same this time around?
I have no idea. Do you think that I'm a Trump whisperer? I have no idea. But the real issue is that nobody has any idea, which is a reason why people are tuning out.
Thank you, Lisa. Up next on the programme, pushing for a ceasefire.
There is a very strong proposal on the table right now. Hamas needs to say yes and needs to get this done.
A conversation up next, live from New York City this morning. Good morning. It is Fed decision day and equities are pulling back by 0.4%. And going into that, equity futures negative, softer. Yields just about unchanged on a 10-year, 468.21. Under surveillance this morning, pushing for a ceasefire.
There is a very strong proposal on the table right now. Hamas needs to say yes and needs to get this done. That is our determination, and we will not rest, we will not stop until you're reunited with your relatives.
Here's the latest. Secretary of State Antony Blinken meeting with Israeli leaders during his 7th trip to the Middle East since October. Blinken said the US is determined to secure a ceasefire and free hostages held by Hamas. The meeting coming one day after Israeli Prime Minister Benjamin Netanyahu said Israel will invade Rafah regardless of any agreement. Bloomberg's Mario Parker joins us now from Washington. Mario, the Secretary of State describing the proposal as a very strong one. He's also described it as extraordinarily generous from Israel. Mario, could you describe the offer that's currently on the table?
Sure. What you're saying is Secretary Blinken essentially trying to apply some public pressure on Hamas to accept this deal, which would include essentially 33 hostages returned in exchange for hundreds of prisoners who are in Israeli hands right now at this point. A ceasefire for about 6 weeks or so. It's a little bit unclear on the exact timeline in that regard, but the consensus seems to be about 6 weeks or so. And then discussions to move toward some type of longer-term peace deal or ceasefire between the two sides.
How big of the gap right now is it between the Biden administration and Netanyahu, who came out yesterday and said they will go into Rafah, but I'm just reading over Admiral Kirby yesterday, who said we can get 6 weeks of a ceasefire, and then we believe, his words, there's a decent chance that we can get something even more enduring.
Yeah, well, what you're saying right now is just politics at play, right? Not only the geopolitics, there's the politics that the administration is feeling on this side. There's the politics that Netanyahu is feeling on his side as well, right? So you alluded to the strong comments that he made yesterday where he said that they would be going into Rafah, deal or no deal. You're seeing some pressure to his right. And keep in mind that Netanyahu is on the right side, but he has some attacks some pressure from the right flank of his own party, essentially saying that if he doesn't invade Rafah, there'll be walkouts, essentially maybe putting his hold on power in jeopardy. So he's trying to thread the needle on both sides there as well.
Steve Cook earlier this morning was talking about how the protests at a lot of universities is really sort of heightening the stakes on both sides, with pressure amping up on Israel, is feeling that they're increasingly isolated and what do they have to lose to go into Rafah, and then a pressure on the Biden administration to try to end this quicker because of the political liability. How do you see it reshaping certain conversations within the Democratic Party?
Oh, it's highlighting just the schisms within the party, right? I mean, if there were schisms along the immigration that we saw earlier this year between the centrist parts of the Democratic Party and the progressive wing, this has gone front and center. I mean, the images, as you alluded to, the images out of the universities across the country, particularly last night at Columbia University in New York, for example, just highlight the pressures that President Biden has. He has to coalesce young voters. He has to coalesce their suburban independent parents as well, who are concerned about probably graduations and the safety of their children on the campuses. And then at the same time, the Republicans are using it as a cudgel against him to paint Democrats as essentially the party that's more hostile toward Israel or questioning their commitment to Israel, but at the same time saying that there's an ineptitude and lawlessness there as well. So it's really boxing the president in this election season.
We saw also yesterday potentially this administration pushing for how marijuana is classified. This comes on the heels of this administration doing a lot of movement when it comes to student loans. How much more can we expect from this administration? I don't want to use the word pandering, but appealing to the younger voters of the U.S.?
Well, we're about, 6 months or so, a little close to between 6 or 7 months out from the election. And what's worrisome for President Biden is the fact that he's still trying to shore up his base, essentially. Before you shore up your base, well, usually at this point in the political cycle, you're doing the outreach, right? So you saw last week there was the ruling on, or the move on menthol cigarettes to cater toward black voters. There's student loans, as you mentioned, Annmarie, as well. And now there's marijuana. All of these policy plays are geared towards showing up the Democratic base.
Mario, can you just build on that a little bit? Because from the perspective of a lot of people, that sounds absolutely ridiculous. Menthol cigarettes to appeal to the black voter. Mario, is that a serious proposal of this administration?
Yes, well, the administration was under a lot of duress, particularly from civil rights groups, right? So demographically speaking, black voters, black Americans are the biggest customers for menthol cigarettes. So civil rights groups were essentially saying, why are you singling out this particular flavor of cigarettes that are geared toward, not necessarily geared toward, but that are used by or consumed by predominantly by black Americans. And so he was under a pressure along those lines to kind of dial that back. And you saw that recognition there, particularly, again, as you look at some of the polls that show that he has to shore up support among that constituency. The last thing that he needed to do was fray even further.
He's certainly feeling that pressure. Mario, you're one of the best. It's good to catch up, sir, as always. Mario Parker there down in Washington, D.C. Equities right now on the S&P recovering just a little bit. We're negative by 1/3% on the S&P 500. Coming up shortly, the dollar strengthening ahead of the Fed decision. That conversation up next with Vasilios Giannakis of Aviva Investors. Live from New York on Fed Decision Day. A little bit of a promo if we can. 1:30 Eastern, special coverage. 2 p.m. decision time, 2:30 news conference with Chairman Powell.
It's going to be so exciting.
Must watch TV.
Absolutely.
Can't wait to watch.
Thank you. So here's the setup. These are the scores going into the Federal Reserve a little bit later. Equity futures, negative here. They were down yesterday too. We're down 0.4% yesterday. April, closing out with the worst day, going all the way back to January. That's how bad April was, to be fair. Decent summary of things. Worst month of the year so far. On the Nasdaq 100, we're down about 0.7%. Amazon up just a little bit in the pre-market. We'll talk about that in just a moment. In the bond market, I want to go through some numbers for you. The 2-year, back through 5%, just about unchanged on the session. This came from Deutsche Bank's Alan Rusk, and I shared this with you earlier on in the show, but I'm going to repeat it for the people just joining us. The 2-year note has rallied on every single one of the last 4 FOMC days. Every single day, Federal Reserve Chair Jay Powell has done a news conference. The last 4, this 2-year note has rallied. Yields have fallen.
It's almost like the inevitability of a Fed Chair Jay Powell news conference. He'll come out, he'll say, you know, the risks are equally balanced. We think that we're in a good place, but we really want to cut. And it's sort of like, you know, Tourette's basically pushing out this idea of a dovish kind of turn of the Fed, which has happened every single time. Does that materially shift, especially given the fact that so many people want to see that disinflation expected to come, like David Rosenberg later, even if we're not seeing right now?
So the difficulty I think he's got today, and I say difficulty, I'm using that word loosely, I think the challenge for the chairman today, if he wanted to be so-called hawkish, people are going around saying he's going to be hawkish, and we've been talking about this all morning. Relative to what? I think it's easy to sound hawkish relative to the dovishness of the previous news conferences, but relative to how much we've priced in the month of April, his tone has already changed in the last couple of weeks anyway. What could he say today that would be incrementally hawkish to what is already priced, which is basically 1 cut for 2024, incrementally hawkish to what he's already said in the last few weeks?
Basically, whether he entertains hiking rates. Basically, if he entertains this and says, look, we could see it conceivably in certain situations, it's something we're open to because we really want to see the data and be data dependent in a more material way. And this is what we're watching. We're keeping it open. We think it's unlikely, but this is where we're going with this, which is somewhat what John Williams was talking about. He says that that's going to be hawkish.
Decision 2 p.m., news conference 2:30. If you're in Japan and you walk through Japan and look up at the Ministry of Finance in Tokyo or something like that, Bramo, tonight the lights will be on. And if you can see the TV set in the corner, they have Bloomberg and they'll have the news conference of Chairman Powell. They'll be watching this too. They will be too. The South Koreans will be, the Japanese, because they don't want him to entertain any more hikes in the face of what's happening in foreign exchange.
What do you think, 170 on the dollar yen?
It's a problem,
I mean,
right?
seriously, what do they get if you end up having a hawkish Federal Reserve chair? Is he Fed chair to the world, or is he Fed chair to the United States? A big debate whether he does sort of shift to the hawkish, how much he's really cognizant of some of the other nations that are going to really struggle.
158, just around the corner. Again, dollar yen, 157.90. This is an issue. Under surveillance this morning, tensions mounting on college campuses nationwide as protests continue against Israel's military campaign in Gaza. NYPD officers breaking up an escalating protest at Columbia University overnight. The university's president asking police to maintain a presence on campus. Annmarie, through at least May 17th.
Because between now and May 17th, they will have graduation. And it's not just Columbia. In the early hours of this morning, we also saw this happen in Los Angeles at UCLA, that police had to go in and break up some of these encampments. And this is going to continue. And this is what the struggle is right now for the White House. I opened up to the New York Times this morning an opinion piece talking about how difficult Biden will have when it comes to winning the Gen Z vote, which was a large portion that he won in 2020. And what's interesting is it's the same issues Starbucks is dealing with. Two factors they mentioned: the intensity of the Israeli attack on Hamas in Gaza and the frustration with an economy many see as stacked against them.
I want to see more reporting on this. I want to understand it better. Eric Adams, the mayor of New York City, coming out and saying that there's evidence of professional agitators. We've heard that before. Other people basically shrug that off and say, okay, that's a straw man argument. I am not sure what the reality is. I don't think any of us are. I really would like to see more reporting to understand what's behind some of these protests, where the motivation is collectively. Is it just divestment? Is it something else? I want to understand it better.
If you're threatened with expulsion and don't care, there's a couple of reasons for that, right? Either you're not actually at the school, you're not enrolled, you're being paid to be there, or you're super, super wealthy and you're a spoiled brat and have nothing to do with these situations anyway, and you also don't care. I can think of very few people from backgrounds that are far less wealthy, that can't afford to go to places like this, that probably get the tuition covered by the university itself, that would still be at those protests. Can you?
No, I mean, that's the reason why I'd like to know more about this, because it doesn't logically make sense. You know, knowing children who are in college, knowing people who are going to go to college, the goal is ambition and setting yourself up for a certain education. Is it something with social media? Is it something with respect to some specific goal that has not yet been articulated? I want to understand better what is behind this, because right now it's kind of a little bit like whack-a-mole in terms of some of the answers that I've been getting.
Isn't this the challenge of connecting with these kids, though, right now? You see these interviews playing out on the news overnight, and you just sit there thinking, this is ineffective, it's not working. We're talking about how ineffective these kids are at college campuses, and we're not talking about the actual humanitarian disaster taking place in the Middle East. In fact, it's a distraction. The protest is meant to draw attention to what is happening over there, and it's actually just a big distraction.
Well, part of it, I think, is also because, and you're seeing a lot of criticism of one interview in particular with a student basically saying they're the victim in all of this, barricaded themselves within a Columbia building, and then blamed the university for not feeding them and called it humanitarian aid, which really the real issue is the humanitarian aid and the dire situation of the Palestinian people in Gaza.
As you said, there's a Shake Shack across the road if they want to leave the building.
There's a Shake Shack, there's a Hungarian bakery up there, there's a
Hungarian pastry shop.
There's a good Mexican restaurant close by.
Look, I think that there's a lot of arguments that can be made. There is something bigger going on here, though, and I want to understand what it is. You think about with social media and some of the images that are being fed to kids. If they're feeling isolated and they're getting images of children dying and families being ripped apart, of course people are very angry. There is a question of the efficacy of what they're actually trying to achieve, but also exactly what is behind this.
We've got the same questions, Lisa. Elsewhere, shares of Amazon posting modest gains in the pre-market. The company's cloud unit posting its strongest sales growth in a year, but delivering a sales forecast that fell short of estimates, reflecting concerns over Amazon's e-commerce business as consumers continue to exercise caution. That name is down by a little more than 1%, or up rather in the pre-market by a little more than 1%, in between 1 and 2% through most of this morning. Elsewhere, the dollar holding steady near its year-to-date high ahead of the Fed decision at 2 p.m. Eastern Time. Vasilios Giannakis of Aviva Investors saying this: for the remainder of 2024, we do not hold a bearish view on the dollar, and stress that Fed easing cycles have not been historically dollar negative. In our base case, that envisages global growth slowing, but the US achieving a soft landing. The dollar is poised for some further upside. Vasilios, I'm pleased to say, is with us now for more. Now, Vasilios, I'm going straight to upside where and against what? Because we've got dollar yen at 158, euro dollar's been stuck between 106 and 107. Where would you look to play that dollar strength?
See, Jonathan, since we wrote that piece, we have seen some rally in the dollar further. I mean, we've come down in euro dollar from 108 down to 106. In dollar yen, we have broken above 150. Now we're at 158. So I think there could be some residual strength in the dollar over the next few months, potentially against the low yielders. Right now, I think preference would be against the Swiss franc because there is that clear possibility that we're going to see an undershooting in Swiss inflation, with the S&P potentially surprising on in terms of more monetary policy easing that's currently priced. But equally, after we see that potential residual strength in the dollar, I think the next big move in the dollar could actually be on the downside, because let's not forget, over the past one and a half months, we've seen a significant, humongous repricing, especially in terms of the Fed. So that means that the risk reward has started flipping. As we currently stand. And if I was to relate that to today's meeting, based on what's priced, which is effectively one rate cut for this year, it will be difficult for Powell to out-hawk the market, given the moves that we have seen so far.
Is that a call for today, Vasilios, or just the next few months?
That's a bit difficult. I would shy away from making these very short-term calls. But I think look, the only way that I can see and sustain further increase in yields and in the dollar is if we get that one rate cut that has been priced, getting priced out in the market. And I think that can happen, at least based on what's going to happen, based on the meeting today, is if Powell completely removes that reference to the possibility of dialing back monetary policy tightening this year. I never say never, but I find this to be a bit difficult or on the low likelihood as an event.
You, like many others, are sounding like it's very difficult to really have conviction about much of anything recently. We've heard that from Jukes. We've heard that from a lot of FX strategists. Can you just give us a sense if there is anything that you have real conviction about, or if you're basically looking for a pivot point where you can kind of get a little bit more kind of confidence?
You said it. I mean, you're absolutely right. Conviction is quite low, not just in the FX market, but I think also in the rates market based on what's priced in. What, however, it has definitely come to our attention is that we've started seeing some relative tentative signs of a rebound in manufacturing, in global manufacturing. We had the second consecutive month where the Chinese manufacturing PMI has been on expansionary territory. And the reality of the matter is that the Eurozone has started surprising a bit on the upside in terms of growth. So I think the dollar is a difficult call. In FX space, some relative value ideas that people could potentially explore is commodity currencies against the likes of the Swiss franc, for example, or euro against currencies where there is a lot of other high rates have priced in, or a lot of monetary policy easing has been priced out. I think a case in point would be sterling, for example, because I don't think in the UK we have felt the maximum impact of past monetary policy tightening. So I think there is a clear possibility that BOV could actually deliver more easing that the market is currently pricing.
A lot of people have been wondering with the euro dollar, for example, about how much we could potentially get a break of some of the sideways trading that we've been hearing, and about whether the Fed is going to really set the tone for the ECB and kind of tie their hands in terms of how much they can cut rates. Are you a believer in that, or do you think that that divergence with the ECB cutting more than the U.S. is going to get increasingly priced in to a currency trade pair that's been pretty flat?
So I think a lot is already priced in. I would find it a bit difficult to see more of that getting priced in. That is not to say that euro-dollar cannot fall below 105, but if I was to look at historically when euro-dollar was trading at 95 to 1, for example, that was back when we were in the midst of the Ukraine-Russia conflict. And obviously we have moved on from there. Eurozone growth is recovering, which means that is putting some sort of a floor below euro-dollar. And roughly the levels that we find ourselves in. The only risk that I actually see quite tangible is US fiscal policy, which I think seems to be on the looser side relative to where we are in the cycle, relative to where employment currently is in the US, which suggests that there is a risk of a bit more persistence in inflation and therefore getting more easing priced out of the Fed. That could be a risk that could pressure Eurodollar lower.
Vasilios, it's been too long. It's going to catch up. Vasilios Giannakis there of Aviva Investors breaking down the situation in the FX market. Haven't done this yet this morning. Bit of data coming out later. 8:15 Eastern Time, you'll get the ADP report. After that, at 10 a.m. Eastern Time, you'll get the JOLTS jobs openings. You'll also get the ISM manufacturing as well. So there's a fair amount of data going into the Federal Reserve decision a little bit later. So the first act is to get through that. We'll do that in about 30 minutes time just to kick that off. Then the Federal Reserve decision later on this afternoon. Let's get you an update on stories elsewhere. Here is your Bloomberg brief with Danny Berger. Hey, Danny.
Hey, John. Dan Loeb has backed up the truck and filled up on AI stocks. His fund, Third Point, now has nearly half of its equity portfolio in AI-related names. In a letter to investors, Loeb said that it made substantial investment in Alphabet in the first quarter. It also added TSMC and the LSE in what it calls AI-driven catalysts. Even so, the tech darlings weren't enough. Third Point ultimately trailed the broader market in Q1. All right, let's get a quick check on Starbucks shares pre-market, down more than 12.5%. Not enough lavender lattes sold. Sales fell for the first time since 2020. One analyst even called it the worst set of results of any large company so far. Other companies that are retail focused, from McDonald's to Amazon, have also flagged more price-sensitive buyers, especially from lower-income households. If this decline holds 12.5%, it will be the biggest drop for Starbucks since 2020. The U.S. Justice Department has moved to reclassify cannabis as less risky. Attorney General Merrick Garland proposed to reschedule the drug. It's currently classified with narcotics like heroin, but it would be moved alongside other medical-related treatments. Shares of cannabis companies surged yesterday with the news. Curaleaf rose more than 25%, and Green Thumb Industries jumped 22%. That's your Bloomberg brief, John.
Danny, thank you. It stinks. You notice that, Manhattan? That's the big complaint right now. Every street corner absolutely stinks.
Yeah, we've actually had some building emails. Basically, if you're the person on this floor,
totally.
Please have respect. Just the smell.
It's amazing how that's become a thing so quickly.
Well, I mean,
I know. Up next on the program, next stop, 5%.
Are we renormalizing to pre-financial crisis levels, or are we just normalizing and then we're going to go back to the low interest rates post the financial crisis? The truth of the matter is 5% on the 10-year or 467 is not insane.
Earl Davis of BMO on a potential test of 5% coming up next. Stocks are lower. We're down 0.4% on the S&P 500. Yield on a 10-year, 467.38. Under surveillance. Next stop, 5%.
Are we renormalizing to pre-financial crisis levels, or are we just normalizing and then we're going to go back to the low interest rates post the financial crisis? The truth of the matter is 5% on the 10-year or 467 is not insane. And if we think about more normalizing, the idea that we're going to cut all the way back to 2 or all the way to some much lower number, you have to wonder whether or not you cut back to at some point, but not to some level that's more post-financial crisis than pre-financial crisis.
Here's the latest. Yields hovering at their highest levels since November as investors look ahead to the Fed rate decision and Fed Chair Jay Powell's news conference. BMO's Earl Davis writing, quote, "The Fed wants to maintain optionality to ease in July or September, but acknowledges the diminishing window, adding tailwinds point to a test of 5% for 10-year yields." Earl joins us now for more. Oh, let's talk about those tailwinds towards 5%. Can you list them?
Yeah, we think there's a high probability and high confidence level that we hit 5%. And part of that reason is there's 3 components to a nominal interest rate, a 10-year yield. One is your break-even inflation. We see the inflation prints going higher, so break-even inflation should go higher. The other one is your real rate or your TIPS, and that incorporates a couple things. It incorporates the future view of monetary policy, of which that's changing, especially with the partial pivot that we expect today. So that's higher yields there, as well as the risk premium. And the risk premium is impacted by inflation and supply. So when you have all the components of a yield pointing towards higher yields and wider yields, it increases the confidence level and probability that you get to that level. So that's how we're looking at it. And we do see a test of 5% coming up.
Test is an important word. What about sustaining that level? How difficult might that be?
That's a great question. In the short term, it won't be difficult, but in the longer term, it'll be difficult. You know, this is one of the things where we will be buying at 5% and above. And part of the reason is higher yields and the market discounting even higher yields than where the present is in the future in regards to forwards. Higher yields will accelerate us towards the end of a business cycle. You know, it's that reflexivity of interest rate markets. So we don't see us being sustainably above 5%, but we could go to 5.25%. But we do see lower rates by 1 year from this time.
This is something we hear a lot, both on the bond and stock side, that we'll be buyers into weakness, right? We'll be buyers into any kind of sell-off. Are you a buyer now, or are you waiting for that 5% level? Are you waiting to sort of see the whites of a 5% yield's eyes?
No, great question. And actually, last time I was on the show was early March, and we, at that point in time, we were tactically long. We switched that over that time. We are short because our confidence level in hitting 5% is increasing with the numbers that we're seeing, as well as there's other tailwinds behind getting to 5%. You know, if you have Japanese intervention, that's possible Treasury bond selling. They're the highest holders of Treasury. So they do have a lot of US dollar on hand, but if they work through that and need more US dollars, they sell Treasuries. Combine that with a lot of technical aspects in the market in regards to no one has any higher yield hedges on, to your point in your question. So people will panic as we get there. So we think it accelerates upon itself. So we are tactically short now, and we will cover that at 5% and start going long.
You talk about some of the supply and demand dynamics behind this increasing conviction around 5%. You talk about the potential sellers. I want to talk about the idea of the U.S. Treasury Department. We do get the refunding, the quarterly refunding announcement in about 40 minutes' time. We'll get some sort of details about how they plan to fund a deficit that is increasing. How much is that playing into your call for a 5% yield?
It's significant. And it's not just the refunding announcement of what the next auction sizes will be, but it's the cumulative effect. You know, last week we had record 2 years, record 5 years, record 7 years, you know, and it's the whole curve of debt that's increasing. So that will definitely have impact. And what we haven't seen in Treasury yields is risk premium. And part of what you need risk premium for is increasing supply, because it has an impact on the dollar in the long term. So you want to make sure you're getting a return and your money back. And to ensure that in this environment, you need more risk premium. And we don't have risk premium in yields yet. And Treasury supply would be one of the reasons why we do start getting that.
Earl, do you see this competing for capital elsewhere? More specifically, is it competing for capital in credit? Are you seeing any sign of that?
I'm going to answer in two parts. The immediate answer is no signs at all. Like, look at the Boeing issue, 10 billion in bonds new supply bonds being issued this week, and 80 billion of bids. There is a lot of cash. So even if it does compete, there's still so much cash there. That was 8 times oversubscribed on one of the largest issues in history of bond issuance. So there's room for it to compete. But to the second part to this question, which is a really good question, it's the reason why we see higher tips and higher real yields. When your economy is so resilient and growing so fast, what the Treasury and what the Fed has to do is take the money out of the growth economy to slow it down. And the only way you do that is by having higher savings rates as reflected by your tips yield. So although we're, at highs we haven't seen in probably 15 years around, or we haven't tested the high of last November, we're going to test that as well, but we'll probably make new highs in tips as well, because you have to take money out of the growth economy into the savings economy, and you only do that with higher real yields.
I'm looking right now, actually, at 10-year real yields, and we're looking at 2.3%, as you said, the highest since last November. As you look out, I mean, there's a real divide about where yields are going to end up. You said if we get to 5%, that'll expedite the sort of tumbling down to another level that's a lot lower, simply because it will slow the economy. What is that lower level? How big could that rally be versus, say, not as much as people think, just because there isn't the same kind of disinflation that's down the pipeline in the same kind of way that there was pre-pandemic?
Listen, our call from December, and we said it on surveillance as well, is we see the range of 10-year yields in the U.S. at 5% to 3.25%. So I think a move to 5.25% accelerates that move back to a 3 handle. Do we see it this year? No, highly unlikely. But Q1 next year, Q2 next year, it's a very real possibility that we see three handle, 3.5, 3.25. So we do see us possibly testing the lower end again. But first, it takes higher yields to do that, to trigger that.
Oh, you've been absolutely phenomenal this year. I say it every time I catch up with you, just absolutely brilliant. This was a clinic, once again, Earl Davis there of BMO and what's taking place in fixed income. We could test 5%. And at the moment, what aren't we seeing? We aren't seeing a profound, pronounced competition for capital with credit, given how some of these issues have gone. What he said there was so important, that you need to take money away from the growth economy towards the savings economy to slow things down. And ultimately, that requires higher real yields.
Basically, the idea of T-bills and chill needs to actually catch on that much more. And then suddenly we'll have the slowdown that this Fed is looking for, because basically it'll take it away from lending to companies that can then use it to expand their businesses and potentially just continue some of the growth and heat in the economy.
Hasn't he been brilliant?
He has.
Year to date, just great.
He also really well framed the whole game theory that's going on in markets right now. We need to get there to slow things down to then get to a three handle. And this is essentially where we're at, which is the reason why I'm very curious about Fed Chair Jay Powell later today when he comes up at 2 p.m. Join us at 1:30 p.m.
Thanks for the
as
promo.
we talk about, how he plays the game theory.
TK may or may not show up, depending on whether he wants to. I can just about see him. I think he's around.
Is this the game theory?
Yeah. Is Tom going to show for the programme? I need to email him the time. We'll take it from there. Coming up, Binky Chowdhury at Deutsche Bank, Jonathan Pingle of UBS, Ira Jersey of Bloomberg Intelligence. So much more still to come. A ton of economic data this morning, and it starts next hour.
Fed is going to, I think, deliver a very, very hawkish message.
How patient will they be to get down to their policy objectives?
They do feel they're restrictive. They would rather just hang out at these levels for longer.
It's entirely possible that the Fed chair could lead us to a path where there's a little bit more tightening of financial conditions.
We need to hear what he has to say, how he characterizes the environment before the market can resume what I think will ultimately be another push higher.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Cricket fans the world over. AMH just compared cricket to Quidditch. Serious story. Actually just happened in the commercial break. Unbelievable.
Because your position sounded like...
Sounded like a position in Quidditch.
Like you were part of the Gryffindor team.
Okay. From New York City this morning, I apologise. Good morning for our audience worldwide. This is Bloomberg Surveillance. This hour, the economic data kicks off. We're looking for an ADP report in about 14 minutes' time. The estimate in our survey, 183K, just to get you set up for payrolls in a couple of days' time on Friday. The estimate in our survey for that, a sneak peek, 240K. Bramo, lots of economic data out this morning.
Two most important points, I would guess, this morning, which would be JOLTS job openings, not the job openings, but the quits rate. A lot of people are going to be looking at that. And then ISM manufacturing. Just how much of a reacceleration are we seeing in the manufacturing industry at times where we're seeing a bit of slowdown in some of the services sectors.
And a read on the employment component as well. I think we're going to get another read on that on Friday when we get the ISM services number. I want to go through some of the corporate earnings. You mentioned this earlier, and I think you're right to do so. How much of a slowdown are we starting to see from the US consumer? And I'll reflect on the comments that we got from a Walmart executive speaking to ABC. And we've heard this on repeat coming out of Walmart over the last few weeks or so. We're now seeing prices that are in line with where they were 12 months ago. I haven't been able to say that for a few years now. It's about the loss of pricing power.
This is from the CEO of McDonald's. The consumer certainly being very discriminating in how they spend their dollar. It may be more pronounced with lower income consumers, but it's important to recognize that all income cohorts are seeking value. So this is sort of the theme that we're hearing. You can say maybe this is sort of dismissing other pressures that these companies are feeling. Nonetheless, it's a theme that we're hearing pretty consistently.
They're seeking value and they're going to be hunting for bargains, what we continuously hear on some of these earnings calls. And they're not in the market for $6 lavender lattes, which was very obvious for Starbucks and where they opened up this morning. I go back to continuously what Mohamed El-Arian told us months ago. Ignore some of this data because it has a lag effect. Listen to CEOs on corporate earnings calls to find out what is really going on in the real economy when it comes to inflation.
Starbucks down about 11% in the pre-market. We'll catch up with Mohammed a little bit later this afternoon, 2 p.m. Eastern time, seconds after that Fed decision drops. Equities at the moment pulling back by 0.4% on the S&P 500. Yields, we've seen quite a repricing over the last month or so. 10-year yields higher by something like 50 basis points. The 10-year at the moment, Lisa, 467.58.
And we were just hearing from Earl Davis that you could potentially get to 5%. You know, I have to say, lavender lattes is not the big thing that I'm thinking about. I'm actually thinking about, the $5 cappuccino. The barrier to entry is so low. And you can go a lot of different places and get a cappuccino for $3.50. And why would you go to pay $5 or $6 for this much? And this is something you actually have potential competition.
Starbucks defends. If you don't drink regular milk, they have a lot of options across the board for non-dairy milks. And also, if you continuously purchase from Starbucks, you actually get a lot of those cappuccinos back for free.
Who paid her?
Let the record show that on the
Starbucks
first day of May on this programme, I mentioned bonds and Lisa didn't talk about them. She talked about coffee.
Okay,
instead.
hold on. The reason why. Wait, hold on a second.
All right, sure. You can have a few
seconds.
seconds, as many seconds as you like.
I'll just have 10, which is basically bonds are fascinating, but right now we don't know which the direction of travel is. Whether supply is going to matter more, whether demand's going to matter more, or whether it's going to be whether Fed chair says hike and then everyone goes crazy.
We're looking potentially for a Treasury refunding announcement in about 26 minutes' time. We'll try and talk to Mike McKee about that. You interested in that or no?
I am. I mean, we got the actual
and what
numbers.
Mike had for his coffee this morning. Too.
What the distribution of what kind of denominations they're going to sell it in. I think that's going to be interesting.
Testing 5% is very different to sustaining 5%. That's a conversation we'll have throughout the day right here at Bloomberg. Coming up on the programme, Deutsche Bank's Binky Charter as traders brace for Fed Chair Jay Powell. Jonathan Pingle of UBS expecting a lacklustre April payrolls report. And Ira Jersey of Bloomberg Intelligence as bonds close out the worst month of the year. We begin with our top story. Stocks falling on fresh inflation concerns. Deutsche Bank's Binky Charter remaining constructive, saying this: we see the pullback as just that. A pullback. The market is well positioned for volatility around the Fed decision. Unless we get a very hawkish shift, we should see the market rally. Binky, I'm pleased to say, joins us now. Binky, good morning to you.
Good morning.
3 fundamental reasons for that pullback. What are they?
There's basically the macro data and inflation and rates uncertainty as the first. That's here and now. We also have the geopolitical risks, and we also had basically, the concerns about mega cap growth and tech earnings slowing. On the here and now, what I would say is that, take a look at what's priced into the vol markets for today. It's a whopping 12 volatility points. And so, what that's telling you is the market's definitely trading and positioning for a vol event. And I'd say, the 2 things that you want to keep in mind is, of course, as Lisa always talks about, the fundamentals and the message coming out of the FOMC is important. But I would argue, given the positioning, unless, it's way outside, far away from what everybody sort of expects, you're going to see those positions having basically to close afterwards. And that's very positive, basically, for the market. And so we've had a year and a half of inflation surprises up and down, and the market's rallied. And most of that just simply has to do with the positioning rather than what happens on that day. So I would say a reversal of yesterday is very likely if we get our house view of an easing bias, being maintained. And the question is, how hawkish is that easing bias going to be?
Okay,
but it's
all I
still
can
an
say,
easing bias.
this is the most bullish call for a pullback I've ever heard in my entire life. We're going to get a pullback, and my goodness, it's going to be the buying opportunity of a lifetime. Because basically, well, hold on a second. We had earlier today Max Kettner coming on. Buy everything. Everything's awesome. It's Goldilocks-y. You come on, there's going to be a pullback, but kind of the same thing.
I actually didn't say that. I was just talking about yesterday and today.
Okay, all right. Carry on.
And perhaps tomorrow, because the positioning is going to roll. I mean, payrolls is important in what we get out of there. So the market tends to position quite a lot in the vol space. All I'm saying is, the market is aware of what's coming and has sort of pre-positioned for it. So the question is, what does it do after that? Is it a message that we get from the Fed that says we are going to go back into 2022 and we don't know, and the bias is hugely positive, and maybe, up the speed and the rest of that. But barring that, it already happened, is the way that I would put it.
So this is actually really important. Are you basically saying that unless we get a real hawkish pivot that's really materially more hawkish than the market is expecting from Fed Chair Jay Powell, rates don't matter? Even if there are no cuts this year, there's only one cut this year, basically that's all been priced in, and the only surprise you could really get to stocks would be an upside surprise if rates rally.
If rates rally, yes. I think the equity market will be up, but I think even if they don't, the market will be up simply because it already happened, and those positions have to either be cashed in. Now, people can stay in, but there's 0 days to expiry options, so you can't stay in for very long because it does expire. You can roll them forward if you think, this is a fundamental and big change, basically.
This is an important conversation, Bink, and I'm pleased you brought up some of these themes because we've been talking about it all morning. We're not sitting here saying the Federal Reserve Chair will not be hawkish. It's just relative to what has been priced over the last month. Exactly. The bar to be hawkish is that much higher. There's some people getting excited by Europe. Mm-hmm. Can you talk to us about how Europe has performed in this so-called pullback over the last month and the kind of signal that you take from that?
Yeah, so, there's two issues here. One is on, the topic of the meeting today at the FOMC is U.S. inflation. And so I think, in terms of thinking about the backdrop, you should also think about European inflation. I would say there's a very wide, broad consensus that, European disinflation is on track. Growth hasn't been particularly strong. And so picture makes complete sense. I would caution with the narrative that, U.S. inflation is sticky because growth is stronger. If you measure inflation in the U.S. the way that we measure inflation in Europe, U.S. inflation is running lower. It fell earlier. We are sitting on the HICP for the U.S.
You're saying it's a measurement
2% for 9 months now. And European inflation, which is on track, is actually catching down to U.S. inflation. And U.S. inflation, measured by the CPI or the PCE is obviously running much higher. What's the main reason for that? It's owner's equivalent rent, I would argue, is the primary and key difference. And nobody pays that. It's an imputed price. I'm not saying we should.
It's going to have consequences either way for monetary policy decisions. And I've got about 30 seconds left. And the simple question I've got for you, given that, Europe or the US, which equity market do you want exposure to?
In near term, we are overweight Europe simply because we are still coming out of basically the slowdown that we had. And I'd say negativity is pretty close to max and has been coming off. Yeah?
Binky, you're one of the best. It's great to catch up with you. It's great to see you, sir. Thank you. Binky Chowdhury there of Deutsche Bank, counting down to that Fed decision a little bit later this afternoon. Let's get you the Bloomberg brief. We can do that with Danny Berger. Hey, Danny.
Hey, John. Shares of Amazon higher by about 1.6% in the pre-market. Its cloud unit posted the strongest sales growth in a year. Now, as for the e-commerce side of the business, not too unlike some of the Starbucks conversation, Amazon sales forecast fell short of estimates. CEO Andy Jassy said on the earnings call that customers are shopping but remain cautious, trading down on price when they can and seeking out deals. So let's get you a check on Starbucks, down 12.5% this morning. Sales at the coffee giant fell for the first time since 2020. One analyst called it the worst set of results of any large company so far. If that decline holds, it would be the company's biggest drop since 2020 of March, the early days of the pandemic. Pfizer, for its part, is higher in the pre-market. Earnings coming out about an hour ago with a sales beat, so up 1 1/3%. It raised full-year guidance, and in a surprise twist, sales of COVID pills were $2 billion, more than double what analysts had expected. That was thanks to an accounting quirk related to an agreement with the U.S. government on unused doses. But now the pressure is on to deliver growth outside of COVID. And that's your Bloomberg brief. John.
Danny, thank you. Binky's still giving me a bit of a clinic on the equity market. That continues. Please, the mic was down. That read on Starbucks is amazing. The worst set of results of any large company so far, according to one analyst. Absolutely remarkable. Up next on the programme, ADP data and a reaction from Jonathan Pingle of UBS. ADP report just seconds away, 15 seconds away. In our survey, the estimate 183K. And you know how this game goes. Doesn't matter, depends what the number is. Then it matters for a second. And then we'll just talk about payrolls for the next 2 days. ADP, the estimate 183. The scores look like this going into it. Equity futures negative by 0.4%. Yields just about unchanged, 467. Mike McKee has the number. Good morning, Mike.
Good morning, John. It's a beat for the ADP number. 192,000 jobs is what the payroll processor says were created in the month of April. That compares to, as you mentioned, 184 last time, which has now been revised up to 208,000. Of course, private sector payroll jobs came in last month at 232,000, so significantly under for ADP, and ADP doesn't consider itself, it says, a predictor of payrolls. Goods producing jobs, 47,000. Construction, 35,000. And manufacturing, 9,000. ADP have been finding job losses in some of those categories, but they do seem to be very strong. 145,000 in service providing jobs. Of those, 56,000 in the leisure and hospitality sector. So it looks like a very strong jobs report from ADP. Remember, they only measure private sector jobs, and that sets the stage for this Friday. Even if it's not a prediction, it does suggest that we're going to get a stronger report.
Mike, it's good they don't consider themselves a predictor. No one else does either, and you know that. 3-month average for payrolls, Mike McKee, 276. That is really punchy going into Friday, Mike. Can you go through some of the estimates for us?
Well, right now, what the Bloomberg survey is suggesting is we're going to see for Friday's number an unemployment rate of 3.8% and 240,000 jobs. So we'll see 190,000 in the private sector. That compares to essentially the ADP numbers telling us what the payrolls number is going to be, according to them. So another strong month. And the bottom line here is the Fed is thinking, well, we're not in a situation where we need to cut interest rates because we've got a very strong, at this point, economy going.
Mike McKee, I just want to finish with the tease ahead to what we're going to get a little bit later. We're going to get that Treasury refunding announcement potentially around 8:30 Eastern time. Can you just tell us what to look for?
Well, the Treasury had said at its last refunding that they are not going to be increasing auction sizes. So we'll take a look and see if they do that, even though the deficit is pretty bad at this point. And also there is an expectation on Wall Street that perhaps they're going to be slashing bill sizes and start terming out some of their sales so that they can bring down the cost of longer-term bonds. But we'll have to wait and see. There's also this buyback announcement that they've been teasing for quite some time. Does that come today as well? So a lot for the fixed income desks to watch for.
Mike McKee, stay close. We'll catch up with you in about 12 minutes' time. Mike McKee there breaking down the economic data and what to look for in the next 10 minutes. If you are just joining us, the ADP report came in at 192. The estimate was 183, so that's an upside surprise. No big price action off the back of that, as you might expect. We're still lower by 0.4% on the S&P 500. On the Nasdaq, we're down by 0.6. In the bond market, yields just about unchanged. We're down about a basis point on a 10-year to 4.67. On a 2-year, down 2 basis points, but just about holding on to a 5 handle of 5.0185% on 2s. In foreign exchange, just to give you a sneak peek of what's happening with the US dollar, mixed against G10 today, against the euro, 106.74 and positive by 0.1%. With us around the table, Jonathan Pingle of UBS. Jonathan, wonderful to see you, sir. 3-month average has been really punchy on payrolls. What are you looking for on Friday? And how on earth does that ADP print inform that view?
We've kind of written a lot about ADP, and the correlation isn't great, right? So over the last 15 months, the correlation coefficient between private payrolls from the BLS and ADP is 0.1, right? So it's a relatively uncorrelated release. I mean, it has some value on its own, but it's not something that's going to change our thinking for Friday, and we are expecting slowdown. I mean, the pace of payroll gains, Jonathan, as you said, incredibly brisk. I mean, punchy is a great word. The first quarter was absolutely spectacular. We actually think some of those gains were pulled forward out of what we'll see in the second quarter. So part of our slowdown is actually, we had extremely warm winter. And when I say extremely warm, like really warm, right? Like Chicago, it was 72 degrees, March 12th, the last survey. Yep. That's like, you're on Lake Michigan, like hanging out on a beach weather for Chicago. So we do think there's a substantial amount of pull forward. We see the first step of that in the April report. So we're at 200K, 165 on private. And we think you're generally going to have a string here of at least somewhat cooler job gains for the economy.
So you think it's weather-related pull forward that's led to that 3-month average of 276?
I think it's a combination of weather-related pull forward. There's also some seasonality. But let's face it. The economy's been strong. GDP growth last year was 3%. You would expect a strong labor market on the back of that too.
You have a really interesting thesis where basically you either get the disinflation that people are expecting and potentially 2 cuts from the Federal Reserve later this year, or if you get a reacceleration in inflation, you could get hikes by the Federal Reserve that take it up to maybe 6.5% next year. Where do you fall on this, given the fact that the data keeps coming in hot, including yesterday's employment cost index?
Yeah, so the employment cost index was a disappointment. But, looking at it, just taking a step back, the year-over-year percent change in private wages and salaries, which is sort of what we look at for nominal wage growth, was 4.3%. That's not really a whole lot different than average hourly earnings through March at 4.14%, right? So you are seeing some cooling. It's a little bit like the inflation data, though. It's disappointing. But we took a lot of comfort, actually, in the recent GDP report. And we've seen, a lot of the fiscal impact on growth has come through this sort of manufacturing plant construction that was really rapid in 2023. Government expenditures and investment were over 4% in 2023. Part of our thesis is that a lot of that fiscal thrust that was, probably a percentage point worth of 23 growth, we think generally comes out in 24. And we see the signs of that in the construction spending data, in the GDP report. So we're still pretty comfortable with our assessment that the economy is slowing at this juncture and that the labor market's going to slow on the back of that.
Let's get to the game theory part of our program, where basically you can say this, but Fed Chair Powell can't. He might believe exactly what you just said, but if he says that, it's going to ignite a rally in markets that then only further pushes the Fed away from the ultimate goal of getting inflation down. Is that basically what you're expecting? That this is going to be a Fed chair who tries to come out and pretend he's a bit hawkish, perhaps more so than he actually feels, in order to just keep tamp down the enthusiasm in markets?
So I don't know if that's the game theory I'd go with. I think in some ways they've kind of gotten what they want, right? Like, we've seen a little bit of the pivot, right? We had, Chair Powell and Vice Chair Jefferson out the week before the quiet period, clearly disappointed with the inflation data, saying, it did not improve their confidence. And in fact, it looks like it's dented their confidence on how they're thinking about their inflation outlook. So I think we will hear that today. And when I look at the market pricing for, last time I looked, it was a little over 1 cut this year. I think that's kind of the committee's debate right now, and we'll get a sense today of where they are. So I think Chair Powell is probably pretty comfortable. I think he will be sort of just as hawkish as he was week before last. The thing I worry about is whether or not there's sort of been a bigger shift than that. And I think we'll find that out really early in the press conference, right? So if we look back to, just sort of the roadmap for the press conference, if we look back to March, Chair Powell starts with his prepared remarks, and it was in his prepared remarks, it's actually in the 7th paragraph in the middle, he's got the sentence where he says, our policy rate is likely at its peak for this tightening cycle. And then the second half of that sentence is, if the economy evolves broadly as expected, it will likely be appropriate to begin dialing back policy restraint at some point this year. If that sentence is still there and unchanged, I think that frames the full rest of the press conference. He's not going to rule out the potential for rate hikes at some point down the road. He's not going to rule out the fact that they might not cut rates at all this year. But if it starts out with the premise that their base case, greater than 50-50 odds, is still that they're going to begin cutting rates this year, I think that is going to frame, all of the other hawkish statements. And the chair probably leaves people somewhat comforted by the fact that there hasn't been a more hawkish shift. But I think he's got basically the markets roughly where they are. And I think that is kind of the committee's debate. Is it going to be 1, maybe 2 if the data starts breaking their way? Certainly if the data goes the other way, they can change their minds later. But I think, for this meeting, I think that one sentence and whether it's reworked is key.
So if he socializes what the market is already pricing in, to be very hawkish, he would have to basically say there is a possibility for a hike, which is something you wrote about weeks ago that actually then started becoming a little bit more normal in financial discourse.
Yeah, no, I think, he's never really ruled out the possibility. He doesn't, I think Chair Powell at this juncture, everybody's been surprised so much in the last 2 years. I don't think Chair Powell's going to rule out anything. But yeah, the degree to which he puts that on the table obviously would be a hawkish shift. I also think that, if they change that language, that it will likely be appropriate to cut rates this year. I mean, if they change that language and discuss the fact that they may need to resume raising rates at some point in the next 2 years, yeah, that would be, I think, significantly more hawkish than what the market's currently pricing.
We'll talk more about this through this morning. You're going to stick with us for another 15 minutes. I want to understand if they change the first paragraph, Bramo. Never mind, what was it, the sixth paragraph of the opening statement?
Yeah, the middle of the seventh.
The middle of the seventh,
yeah.
OK, forgive me. The first paragraph, this characterisation of the economy. Job gains have remained strong and the unemployment rate has remained low. Inflation has eased over the past year, but remains elevated. I want to understand how they sort of reword that if they need to after the first 3 months of this year.
Has the disinflation narrative really taken a hit in a material way? And that's really, I think, what you're getting at and what a lot of people are going to be looking for at a time where job growth is strong, yes, but what about that other side?
Jonathan Pingler, UBS, is going to be sticking with us. On the other side of this commercial break, the US Treasury refunding announcement. Mike McKee is going to break that down for you when we get that information. And then we'll catch up with Ira Jersey of Bloomberg Intelligence, looking ahead to that Fed decision later on this afternoon. Equities are lower from New York. This is Bloomberg. Just moments ago, about 15 minutes ago, we had the ADP report that came out at 192. The estimate was 183. That's ahead of the payrolls report. The estimate in our survey, 240K. That's 2 days away. Looking at things elsewhere, equity futures right now off the back of that. Equity futures still negative by 0.4% on the S&P. On the Nasdaq, down by 0.6. The bond market, where the fireworks might be over the next few days, particularly this afternoon. The 2 years down by a couple of basis points. The 2 year, 5.01%. We're down a single basis point on a 10-year, 466.34. The so-called Treasury refunding announcement has just dropped. Mike McKee's in Washington to break that down. Morning, Mike.
Good morning, John. Well, the auction sizes are unchanged as the Treasury promised, but we do have some other news. In terms of the auctions, $125 billion is going to be offered next week. $107.8 billion of that goes to refunding, $17.2 billion in new cash. Now, there was a thought that the Treasury would reduce bill sales, but they're not going to do that, at least not over the longer term. A slight fluctuation, they said, in the current month, and then in June they go back to the highs of February and March. A surprise since Treasury bills are above the 20% to total Treasury issuance level that the Treasury likes to have. They're also going to make 6-week cash management bills, a benchmark bill that had been signaled for some time. And the other news is the buybacks. Treasury is going to begin the long-teased buyback program on May 29th. Weekly liquidity support buybacks will be held of up to $2 billion in coupons, and buybacks will begin under a cap of 20 separate CUSIPs, 20 separate bond issues, and that cap will eventually be lifted. So buybacks are going to begin with off-the-run treasuries starting May 29th. In terms of the refunding numbers, as I mentioned, unchanged, $58 billion in 3 years, $42 billion in 10 years, and $25 billion for the 30-year. So Treasury is keeping auction sizes unchanged, but doing some work around the edges in terms of issuance.
Just to be real clear, though, about the buyback program, this is mostly just for liquidity, right? This is liquidity management to take some of the off-the-run treasuries out of the market and put some more traded ones on the market. I am curious about what the signal is here, Mike, about the fact that it's more heavily weighted to T-bills. Is this basically an idea that eventually yields will come down? You don't want to lock in the rates where they are?
Well, that may be. They're not explaining in today's announcement why they are staying with basically the skew towards T-bills, but it does have the effect of longer term reducing liquidity. So the Treasury may have to change going forward, especially when they get into the third quarter when issuance is going to have to rise significantly. So at this point, it may be just kind of a holding action.
Do we have any sense, Mike, we talked about the earlier announcement on Monday about the borrowing plans and how it came in above a lot of estimates, $41 billion worth, not necessarily a massive number in the scheme of things. But do we have a sense of whether they've gotten fewer tax revenues than they were expecting? What makes up the deficit that we've seen in some of the Treasury's books?
Well, it's partly tax receipts and partly projected tax receipts, but also spending has been higher. So the government has got to make up the difference, and that's why they're going to be borrowing more. They anticipate, at least in the third quarter, of over $800 billion.
Mike McKee, stay close. We'll come back to you on that deficit in just a moment. If you are just joining us, bonds still bid, yields still lower on a session at least. We're down 3 basis points on a 10-year, 4.65 on a 2-year, down 3 basis points. Just about holding on to that 5 handle on the 2-year. Going into a little bit more economic data later, including the JOLTS report, then onto the Federal Reserve this afternoon. Jonathan Pingle of UBS is still with us. Jonathan, we've been talking about the effort the Federal Reserve needs to go to get inflation back down towards target. How much of that is being offset by what's happening in Treasury, the amount of issuance we're getting, the amount of fiscal easing we've seen?
Yeah, fiscal policy, in our view, is a huge support to 2023. I mean, we all talked about, the Biden administration programs, the CHIPS Act, the IRA, and we were all watching sort of this extraordinary boom in chip manufacturing, chip plant manufacturing, construction, all the related EV plant manufacturing, construction. I mean, structures investment in 2023 added roughly half a percentage point to year-over-year, Q4 over Q4 GDP. So, 3% GDP, half a percentage point of that was the structures investment. Direct government spending and investment, the public sector investment, add on a little bit of the deficit widening, it's a percentage point. So a third of the growth that we saw. And, we generally think of the government as being somewhat, kind of interest rate insensitive, right? So, so this was definitely a thrust that the Fed was forced to fight in 2023 with higher rates that, really wasn't going to be affected by monetary policy.
You keep saying 2023. Can we talk about 2024? How sustainable is that? How much money is still being distributed every single day into the economy off the back of these programs?
A lot less. I mean, if we think about it in terms of growth rates, it's sort of like we moved up the level. Now we've got these wider deficits and this level, but the level now is kind of staying the same for a while. And that means the impact on growth is essentially going to zero in 2024, in our view. And this is sort of a natural way of thinking about fiscal policy, right? And this is why it's countercyclical. You widen the deficit in bad times but we've ended up sort of widening the deficit in good times. We've had the growth benefit, and now we've got sort of the wider deficit, and the growth impetus is sort of fading at this point.
As an economist, do you think that the likelihood of the U.S. Treasury Department more heavily weighting the issuance to T-bills makes sense? That basically you can capitalize on the demand for short-term T-bills, T-bill and chill, what everyone's been talking about, and not lock in 5% yields over a longer period of time. Is that what we can infer from this announcement?
So, I mean, the Office of Debt Management, they are trying to minimize the interest expense for the taxpayer, based on their calculations. And depending upon history and how interest rates may or may not unfold, you do want some mix between bills and coupon issuance. I mean, there was a long debate pre-COVID whether or not the U.S. should term out its debt a lot. And a lot of those models actually don't say terming out the debt is really the most cost-effective thing to do for the Treasury. But a lot of it's pretty uncertain, too, right? I mean, it depends on the outlook for interest rates, inflation. At this point, net interest payments are, more than defense spending. You're talking 3% of nominal GDP is just paying interest. It's almost 20% of federal government revenue. So, that could get a lot worse if rates stay high and inflation stays high, or it can get better if the Fed starts cutting.
I mean, in other words, another way to frame this question is, do you think that the Treasury is making a call that longer-term interest rates are going to go lower and that this isn't an opportune time to lock it in?
I can't peer into Janet Yellen's mind and actually I can try, but I do think though that the Treasury is trying to balance what they're seeing on the yield curve. I mean, if that's sort of what you're getting at, and I think that's probably an appropriate thing to do for short-term funding needs, right? We certainly have seen in the money markets a reasonable appetite for bills. I mean, you can see that in all of the money that gets parked at the reverse repo facility at the Fed. I mean, the money markets are still relatively awash in cash, high levels of reserves in the banking system. So that would indicate, all else equal, that there's a lot of capacity for bill issuance there.
You talked about fiscal policy, so there's more money coming out, but there's also more people, which is propping up this economy we're witnessing. How do you see this potentially changing next year?
Well, I mean, I think the budget choices get hard, which is one complication, but the presidential election, is a hugely consequential election for fiscal policy. If we think about what's unfolding in tax policy, most of the individual side of the 2017 tax cuts expires at the end of 2025. And because that's written into current law, that is something that Congress and the next administration are going to want to address, because otherwise it's going to be roughly a almost $3 trillion tax increase over the subsequent 10 years. The plans to pay for that are likely going to look very different comparing the Democrats to the Republicans, but that could have a huge amount of impact on fiscal policy as we look out to 25 and 26.
Secretary Yellen got a grilling on this on Capitol Hill just yesterday. I'll bring a quote up from her statement. "We can make these investments while reducing the deficit by $3 trillion over a decade through a combination of smart savings and tax proposals." I want to bring in Mike McKee. Mike, down in Washington, you witnessed some of that hearing, I'm sure, watching the tape being played back. What did you think of the proposals coming out of the administration? How do they do this? Make these investments while reduce the deficit by $3 trillion over a decade?
Well, they haven't put out an exact plan yet, but the important point for the administration is they do not plan to increase taxes on anyone making $400,000 a year or less. Now, Biden didn't mention that when he tweeted that the tax bills need to sunset because the deficit is too high. So there was a big back and forth up on the Hill about whether they would do that or not. Yellen insisting they will do that. But there's going to have to be a way to make up some of the difference between the two sides. Although we are going to have to also see, as Jonathan said, the results of the election, not only who's president, but who controls each house. If the Democrats are in charge of the House and Senate, it's obviously easier to let the tax provisions expire. But if not, then we may end up with a real fight on our hands over how far they're willing to go, both sides.
She really got a grilling on this because when Biden's campaign tweeted about this, he left out the fact that he wants to keep the tax cuts for families making under $400,000. But Mike, does this just come down to the point that they're going to pay for this by raising taxes on everyone else above that threshold?
Yes, what they've outlined in the past is that taxes go up for people above that threshold, of course, on a graduated basis, and business taxes, corporate taxes, will probably go up, but they won't go up to where they were before the original tax cuts. They'll go part of the way there. There was a hearing not long ago in which officials from the Biden administration were saying, look, the economy was fine. With the tax, we would be fine with tax rates that are a little bit lower, but not as high as they were. We don't have to go all the way back. They'll try to sell it that way.
Jonathan Bingle's still with us, and I am curious, Jonathan, as you listen to all of these proposals and you listen to Janet Yellen's hearing yesterday and her speech coming later this week, how much dispersion is there about your potential outcomes for the economy based on the divergence in tax and as well as tariff policy between the two candidates?
Yeah, I mean, we've written a fair bit on this, and it's a pretty big gap. I mean, in looking at some of the plans that have been put forward and what we can glean from the campaigns, it looks to us like, essentially a Republican sweep, so if former President Trump wins the presidency and the Republicans take both houses of Congress, that they would want to fully extend all of the tax cuts, potentially have some pay-fors, but also reduce some other taxes. And, the Biden administration, I mean, what you can glean both from, both from the president's budget proposals this year and last year, is, as Mike would say, they would, fully extend the tax cuts for those households making under 400 or potentially 450,000. Let taxes rise back to the old marginal rates for those making over. But then you could also work on corporate taxes, potentially raise the investment tax, and maybe even capital gains taxes for upper income individuals. Those are very different outcomes. I mean, you really are, over a 10-year budget window, talking about, trillions of dollars in differences between, what the deficits would look like under one set of plans or potential compromise or another. And I think we get the historical template for that is the expiration of Bush tax cuts in 2012, which was very much a similar playbook. The tax cuts expired for the upper income households, were extended for those making under a certain threshold. So we sort of have run this playbook before, and we can see what sort of a divided government outcome might look like. But certainly the Republican wave offers a much different fiscal stance, potentially.
When does the deficit matter then, economically? When is it actually a drag on the economy rather than a boost and this sort of fuel for American exceptionalism?
You know, the deficit in some ways already matters. I mean, we saw last fall, term premium getting pushed around from the refunding announcements as we went from August, through November. And I think we could also make a case that, we're already making choices that are difficult, constrained by our, budget pressures, whether it's our defense spending, our geopolitical posture. Our fiscal stance and fiscal position now, I think, is already starting to influence policy and the choices we're making for the economy.
On this Fed day, how seriously do you take proposals of eliminating the Fed independence?
Well, I worry. My hope is that cooler heads would prevail. I think, Congress obviously would play a very important role in the ability of any administration through appointees or through legislation to try to alter the position of the Federal Reserve System. But, as a former Fed staffer, I think that, monetary policy independence is absolutely crucial for a well-functioning economy.
But it's mandated by Congress, something that potentially the president, former president, which maybe the future president could do unilaterally, is tariffs. And he talked about this extensively in this sit down with Time magazine. And he said potentially that ring around the country that he calls it could be more than 10%. And he says, I also don't believe that the costs will go up that much. How inflationary is, say, a 10% or bigger tariff roll around the United States?
Well, if it's on everything, you could imagine that, this is going to feed through, pretty quickly and broadly to consumer prices. It's really going to hinge on, is it everybody? Is it just imports from China? I mean, I think that's sort of the crucial question that we're all trying to grapple with, right? Whether or not they really are going to follow through with this, and whether or not, Congress could have a role in stepping in. They have delegated a fair amount of trade authority to the executive branch in the U.S. through these various provisions, national security, trade, protectionism, et cetera. But, there is also a chance that, Congress could weigh on this issue as well and try to limit the amount and breadth of the tariffs, because it would impact other treaty arrangements that we have.
He can do a ton with executive action, that's for sure. Jonathan, it's good to see you. Jonathan Pingle there of UBS breaking down the data this morning. The ADP report about 30 minutes ago. Small upside surprise. And the Treasury refunding announcement of about 15 minutes ago. No big changes. Equity futures on the S&P negative by about 0.25%. With your Bloomberg brief, here's Danny Berger. Hey, Danny.
Hey, John. CVS shares down more than 13% pre-market. The pharmacy chain cut its yearly earnings outlook for the second quarter in a row. In a statement, CVS said the trend towards higher medical costs will persist throughout the year. If these losses hold, it would be CVS's biggest one-day drop since 2022. Barclays job cuts have arrived. Now, we reported a few months ago that Barclays was preparing to cut several hundred investment bankers, and those dismissals have started today. They focus on staffers in global markets, investment banking, and research, according to people familiar. The job cuts are part of a £2 billion cost savings drive, with the CEO under pressure to improve returns and catch up to rivals. Now, the stock market might not be able to rely on Fed cuts anytime soon, but it can surely rely on corporate buybacks to boost shares. New research from Goldman Sachs says that total share repurchases will surge 13% this year, and then next year they'll cross $1 trillion. More confidence in economic growth means that companies no longer feel the need to hoard cash. You've seen it in companies like Alphabet, whose hefty cash pile allowed it to buy back shares and announce its first ever dividend. That's your Bloomberg brief. John.
Danny, thank you. Appreciate it. Up next on the program, counting down to the Fed.
When you have all the components of a yield pointing towards higher yields and higher yields, it increases the confidence level and probability that you get to that level. We do see a test of 5% coming up.
That conversation just around the corner. That decision later this afternoon from New York. This is Bloomberg. Equity futures just off the lows. Equity futures down about 0.25% on the S&P. Yields a little bit lower. The rally sticks, if you can call this a rally. We're down about a basis point or two on a 10-year, 466.34. Under surveillance this morning, counting down to the Fed.
When you have all the components of a yield pointing towards higher yields and higher yields, it increases the confidence level and probability that you get to that level. So that's how we're looking at it. And we do see a test of 5% coming up. We don't see us being sustainably above 5%, but we could go to 5.25%. But we do see lower rates by 1 year from this time. We are tactically short now, and we will cover that at 5% and start going long.
US Treasuries coming off their worst monthly performance in more than a year as traders pair bets on Fed easing. Some looking for a retest of 5% on the US 10-year this morning, 466.34. Joining us now is Ira Jersey of Bloomberg Intelligence, looking ahead to that Fed decision and Chairman Powell news conference. Ira, wonderful to see you. What are you and the team looking for later this afternoon?
Yeah, so it's going to be devil in the details, I think, in particular. So firstly, any announcement or pre-announcement about quantitative tightening going from $60 billion of treasuries maybe to 30, but that may not start until July at this point. But certainly any announcements about that would potentially be a little bit of a dovish signal. But I do think that Jay Powell has to be very balanced, and the market certainly has edged that way over the last couple of weeks, with options markets, options on SOFR futures now pricing for the chance of a hike, right? So people are hedging for that potential possibility, just given the economic data we've had.
What rhetoric in the statement and in the press conference do you expect to hear that could indicate that they're actually open to that versus just simply humoring a question on it? In other words, are you expecting to hear them say that the trend of disinflation has stalled out, has not been making progress, is really a more significant problem?
Yeah, so I would be listening for, in the opening remarks to the press conference in particular, Powell's been very regularly saying we've made a lot of progress on inflation. So saying something like you suggest, Lisa, like inflation, the progress on inflation hasn't been as, robust or as significant as we'd hoped. And because of that, we will continue to do whatever is necessary to make sure that inflation comes down to our target. I think the Fed has a little bit of a challenge here because they've kind of boxed themselves into a corner by not having a more flexible inflation target, right? When they said that they had some kind of average inflation targeting, you can fudge that based on what your look back period is. But now that they're, continue to say, hey, we want to have a hard target of 2%, the possibility that they hike continues to go up as you get, good hard data. I know we've gotten, consumer confidence numbers and some survey data that's been weak, but most of the hard data that we've seen continues to be pretty good, and that's something that I think that the Fed is trying to grapple with, this idea that some of the forward-looking survey data just isn't working at the same lags that it has in the past. People are not spending their confidence, right? Or they're spending way more than their confidence, for example. So because of that, I think that the statement has to be at least a little bit on the hawkish side. Will it be more hawkish though than what they said over the last couple of weeks? I'm not sure that it will be. In fact, I think people might be disappointed that they're not more hawkish, particularly the bears and the people who have set shorts over the last couple of weeks in the Treasury market.
It sounds like you agree with a lot of people who say that right now this is a market that's positioned to actually rally, that you could see some sort of bears being blown out of their positions if the Fed doesn't deliver the hawkishness to the degree people are expecting. Is that a correct characterization?
Yeah, I think that's fair. In the Treasury market, technical levels matter a lot because people put in stops or reverses and the like. And so 4.7% on the 10-year yield will be that key today. So if we blow through that because of something in the statement that sounds hawkish, or if Chair Powell sounds hawkish in his opening remarks, and you blow through that, we can wind up, at 475 or 490 even maybe by the end of the day. You have seen 15, 20 basis point moves on just a couple of statements here and there from out of the Fed. So that the market, I think, is kind of set up for either, a rally or a sell-off one way or the other, with, 5% that being in sight for sure. But then again, if we hold that 470 because he's not as hawkish, then you can wind up, retesting 450 in a hurry as well. So I don't think it's necessarily symmetric, but I do think that people are kind of set up and hedged for a more hawkish Federal Reserve.
Ira, we're 3 hours into this programme, and up until now, I don't think anyone's mentioned taper QT once. Isn't that going to be a main event a little bit later?
Yeah, well, I did earlier. That is certainly something that we're going to be looking for. I think the challenge with tapering QT, that there's structural reasons to do it, right? And I think that there's people who say that the Fed's balance sheet is way too big and stuff, but the way that the banking sector is set up today and the need for the amount of bank reserves to meet Basel regulations is underappreciated by a lot of market participants who are outside of the nerds in the rate market like myself. But tapering QT doesn't necessarily stop the Federal Reserve from increasing interest rates or reducing interest rates at some point in the future. And I wouldn't take it as a dovish signal. I think that one thing Jay Powell has to do when he talks about Q2 is say, look, we're doing this to ensure appropriate market function and ensure the banking sector has the reserves that it needs to function properly. And they'll talk more about their financial their financial stability mandate in doing that. And they'll try. He needs to disconnect the QT element of this more from the rate element, right? So they haven't done, I think, a great job kind of separating the two at this point.
Up until now. Ira, thank you. Ira Jersey of Bloomberg Intelligence. Good to hear from you, sir. Fantastic lineup coming up a little bit later on this afternoon on the surveillance special, The Fed Decides. Here's the lineup for you. Bob Michael, JP Morgan, Kathy Jones, Charles Schwab, Matt Lazzetti, Deutsche Bank, the brilliant Mohammed Al-Aaron of Queen's College, Cambridge, Diane Swank of KPMG, Bank of America's Michael Gapin, former New York Fed President Bill Dudley, and Jeff Rosenberg of BlackRock. It does not get any better than this. The programme starts at 1:30 Eastern Time. The decision at 2 p.m. From New York, this was Bloomberg Surveillance.